What's up, everybody? Good morning. Welcome to the stream. Wait 1 second. Ayo. Still working on my laptop. I'm on my laptop today still. My computer is still in pieces on the floor. The process of rebuilding everything, a new machine, all that. So I don't have all of my stuff in front of me, but that's okay. We're going to do the best we can. I have a special stream plan. Go over some trader funding program tricks. Loading everything up right now while everybody's jumping in here. I buy new parts. Yeah, I'm basically buying all new everything now. I've convinced myself to buy all the stuff. All new everything. Let me get all my stuff loaded up here. Oh, I need to load. Hold on 1 second. I need to make a stream on PC building. Oh yeah, I should do that. That'd be kind of fun. This time though, I'm just going to get the parts and I don't really have time to do the build. And I'm going to take it to like Micro Center and get them to do it for me. I'm not doing a water cooling build this time because I want to swap out components. For the stream, I'm realizing in case the stream has issues, I can't just easily like pop in a new hard drive. I made such an effort. So for the streaming computer, going forward, I'm just going to have a simpler system. I love setting it up though. It's my favorite thing. I ripped out all my water cooling stuff last night. I even got out scissors and was like cutting wires and stuff because I was just like, get out of here. All right. Okay, give me 1 second to get everything ready here. Hey. Go to my drawing tool here. All right. Stop throwing it. Oh, I know why it's doing this. Okay. A couple more things. Let's load up. More things. All right, so today we're going to go over some tricks of the trade on how to beat trader funding programs at their own game. This is one of my favorite things to talk about. We don't really get a lot of time while we're streaming to sit here and actually talk about this. There's a lot you can do and a lot of things you need to consider, but there are tricks to getting funded as fast as possible. There are special times you should trade, special moments you should trade, special setups you should trade. There's a lot of times if you're struggling, there's a rule of thumb, in baseball, for instance. Anybody here is a baseball player, right? Or was a baseball player. As a kid, I was a baseball player. My brother. Yeah. You really have a swing. Like you swing the bat a certain way, you pitch a certain way, you throw the ball a certain way, and the way that you get a different result is you can't really change. It's so hard to change your swing up. Or you guys play golf or something, right? Really hard to change your swing up to learn a whole new swing. It's like muscle memory. It's how you are. It's who you are. All of that's baked into what you do. So there are step changes you can do to hit the ball better, or to do whatever. Like you can choke up the bat a little bit, or choke down the bat a little bit, which is like put your hand up and down different parts of the bat. So your swing is different, but your swing doesn't change the way you do it. You can step up in the batter's box, for instance, and sort of step back in the batter's box, but your swing is the same, but your performance is different. Immediately take a little step change. My laptop stops the voice at the end of the sentence. Hold on a second, talk here. And so what you're going to do in a trader funding program is basically that. You're going to move around in the batter's box. You're not going to change much of what you do, but you're going to do it at different times or different places. And it really is the best way to get ahead, I would say, as far as in trader funding programs. You're going to do your behaviors. And it's really hard for me to say change your behaviors, because it's one thing you're not going to easily want to do, because everybody does a certain thing and you're kind of in a routine on doing that certain thing. And going forward, as you're trying to learn newer stuff, the easiest way is just different application. If I told you only trade on a Tuesday, that's not really a rule, but you wouldn't have to change what you're doing. But what if Tuesday had a better chance of winning with the style that you trade? That is kind of what the premise is of what I'm going to talk about today. Can I talk about that Apex payout that somebody posted yesterday? What about it? I didn't see it. I've been completely out of the loop for a couple of days. What about it? Somebody, I think everybody's talking about Jade Cap is requesting his payout for like close to 3 million, something like that. Somebody said, is the boot camp a $20 charge for the boot camp a recurring fee? Yeah, it's a recurring fee, Michael, because it's a continual process. We keep going with the boot camp. At the end, we start over and go over again. Markets are closed today, but we're going to spend, listen, every time markets are closed, though, we don't take a day off. We stop and we spend this time to get together to learn something. And that's what we're going to do today. We're all going to learn something together. This is going to be fantastic. So if you guys don't know me, my name's Matt. I'm a full-time day trader. I live stream on YouTube. I probably put up some of the best stats on YouTube, I guess, compared to a lot of the other YouTubers. I share my monthly reports, my progress reports, progress statements, everything. And you can see what I do. I even tweet my results and all that. And why is it that I can pull consistent numbers? In this environment right now, I'm trading 75% win rate. The Tradeify, 75%. And this is the craziest market. How? Like, how am I doing it? And even waking up every day and trading, even against what? Screenshot of this. Pull this over. This is over the course of these, this is since, I guess, March. Over the, even streaming, I'm forced to trade more than I normally would. So even under those conditions and under the pressure of these conditions, 5,000 people watching me every day, how do I manage to pull such a high win rate in the worst, craziest bear markets where Trump tweets something, market goes all over the place? There are tricks. There really are tricks. There are tricks to day trading. I'm known as a high win rate trader. There's two different kinds of traders. You either have a high win rate and you can take a lot of base hits and your base hits just slowly pay out, or not slowly, they grow steadily over time. Or you are a high risk to reward trader, or high reward to risk trader, which means with a low win rate, you just win big and lose small. That's typically going to be most people because most people don't have an edge. Most people can't sustain a greater 50% win rate. You can only sustain a greater than 50% win rate if you have an actual edge in the market. I have an actual edge in the market. I have something that works upwards of 90% of the time. And therefore, I don't need to be in the market a long time, a lot of the time. I wait for my setup, I take my setup, and it usually wins. And therefore, I'm in and out quick. I'm not in the market half the day, and then Powell says something or Trump says something, and there goes my accounts. You've never seen me in the history of me streaming blow up an account live on stream and get forced liquidated. You've never seen me trade all of my Apex accounts or whatever accounts together and blow them all up in a single day and start over. It's never happened once on this stream, and I stream every day. Why is it that I don't blow up? You guys blow up when you trade? Pop quiz, just so we get started. Y'all blow up when you trade sometimes? I mean, I do. I bust an account every once in a while, but an account, never 20, never 19, never 18, never 5, 1. The other 4 are fine. I stagger my risk in a way so that I never get busted. What's software am I checking my win rate? This is Tradeify's own website. So Tradeify, which is the trader funding program that I've been using, does it for you. I'm not tracking it, they do it. So this is from their website. If you ever used Tradeify before, they have a program that tracks your trading performance there. Okay. So let me give it a couple minutes to everybody to chill out here so I can kind of make the post of the stream. And we're going to go over some really cool tricks. I'm going to teach you guys how to have a high win rate with trader funding programs. And you guys during the session can ask me questions you want to know. It's a holiday. We usually have a very massive turnout of our live daily streams. So being a holiday, we're going to have whoever's around is bored. Maybe you guys are still going to work. Maybe you guys are still, maybe you don't have the day off. So every time we have a holiday, we like to sit back and turn into a lesson for everybody. All right. So how I have 75% win rate in my trader funding programs. Okay. Unfortunately, market is closed today. Hello. Okay, so quick question. How many of you guys would say that a lot of the times, okay, first question, when you were trading prop firms, do you trade all your accounts together or do you stagger your accounts? Like meaning that you don't trade all of them together, you individually trade them or split them into smaller groups. Individually trade them, probably because I taught you guys, well, maybe a lot of you because I probably taught you guys that, but But before that, did you guys trade them together? Copy trade, and you've transitioned after watching me for a while. Okay, cool. So we're going to go over a couple of things. This is how you make do in trader funding programs. Okay, I'm just going to write on the screen what we're going to talk about today. Number one, when to trade. When to trade. Number two, what environments? Okay, what environment to trade in? Number three, what setups that you can take that have high win rate. Teach you by high win rate setups. And then we'll do some general avoidance tricks. When to avoid. Okay. These are very important pieces of a solid trader funding program strategy. When you're trading in trader funding programs, you're not necessarily trading. This is kind of the biggest misconception of all. You might think it's trading. It's not really trading. You're more like, you're in a contest. It's a game that's trading themed, but it's kind of like when you throw a softball at a bunch of milk bottles at a carnival. It's not softball. You're not playing baseball. You're not even pitching. It's a game that's designed that's softball themed, but the ball you're throwing and the pedestal you're throwing it to, and I mean, things are designed to work against you. And that's the last thing that we're going to teach you as far as in this day is how to game the system, how to beat the game. There are tricks to game their system. There are tricks around every single rule. Consistency rules, DCA rules, it doesn't matter. There are tons of tricks that you can do to get around every single one of them. That's it. The casino has a rule, break it. Get as close as you can to breaking it or getting around it without violating the rule and not getting paid out. That's your goal with the trader funding program. It's not illegal. This is a game. Game the game. The game is trying to game you, so game the game. Quick example, right? You have 5 accounts and 2 strong bull pivots you're going to trade on. Let me open up a futures chart really quick. Hold on one second. Let me refresh my platform here. Hold up. A second. Load this up. And I'm on my laptop, so I have like limited resources today. But give me 1 second. I don't have my millions of screens in front of me. There we go. So an example is, in a futures account, they might say, there's no dollar cost averaging rule. It's one of the main rules they have in a trader funding program. And dollar cost averaging is, you can't add to a loser and turn into a winner. Prices are falling, and then you buy here and buy here and buy here, and ultimately you win. And they say you can't do that in your accounts, but you can. As a matter of fact, in trader funding programs, any rule they tell you that you can't do is because the rule ups your win rate, and it's something that you should do. They wouldn't have a rule for your own benefit that says, don't do this because it's just not cool. They have every rule they have is to lower their risk. And in a zero-sum game, when their risk is lowered, your gains are lowered. Your success is lowered. When their risk is higher, your success is higher. So anything that lowers their risk lowers your chances of winning. And so why you can't dollar cost average in? Well, I'll give you an example. You buy straight to funded programs. Say you buy, a million of them. You can just long and 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 long, and eventually you could just throw along every 10 points. The S&P falls, and half of your accounts will pay out or get funded. And let's say that like a coin flip strategy. This is a hypothetical. You're not going to do this, but this is why the risk program is the way they are. In a coin flip strategy, say that Apex is having 90% off sale, and you're out there paying $20 per account. $20, that is your unlimited, funding there. $20, you can buy as many of those as you want. So that you long, and then long, and then long, and then long, and then long the whole way down. And then every single time one of them, busts, it's out. But then every single time one of them moves up, 20 points, you actually pass the eval. This one fails. This one passes. This one passes. You just YOLO the account. It doesn't matter. Just as full max position as you can. It looks like along the way down, some of them failed, some of them passed. And then you long this one and it wins, and long this one and it loses, and long this one. And so you might have spent $200 or $300 that day. And of the 50 attempts that you made, let's say that let's an example, and this is what people do. By the way, this is how your favorite influencers and streamers actually post $1 million payouts. There's a trick. You think these guys are out there slaying in the stock market. Oh, no. They're tricking the system, and I'm going to teach you how they do it. All your big influencers, nobody's getting $500,000, $1 million payouts without doing this game. This is the trick they do. They just throw as much money as they can at the market at $20. And say that you buy 40 of those accounts, okay? Right? That's not a lot. That's, what is that? $800? That's all you spend is $800. When I started futures trading, I could lose $800 in my real account in like 3 seconds in the NASDAQ. You know how that works, right? Okay. So $800 to buy 40 Apex accounts when they have a 90% off sale. And then you have, of those 40, you just randomly long all of them at full port. Okay. Randomly split them all up. By the end of those 40, let's just say half of them win. So now you have 20 PA accounts. Let's call it funded. 20 funded accounts at $800. How amazing is that? Now they can all start making money. And then of those 20 funded, you repeat the same trick. And then you lose even, say we lose 75% of those. And of those 20, you just long full port, long full port, long full port. And say at this time, instead of half of them pass, 25% of them pass. So you end up with 5 accounts that meet payout. That meet payout criteria, especially if somebody doesn't have a consistency role. You just full ported. And it costs you $800 for the evals. Plus, when you activate 20 is $1,600 more. It literally only costs you $2,400 for 5 payouts of $50K. Literally, that's it. The stats are the reason they have to put rules on there so you can't do this. And the reasoning that a lot of your big prop influencers do this is because they'll do this not only in one account. Let's call this company A. Okay. And they're doing that on the long side. Well, go to company, and remember, the reward to them is very possibly big, even if only one account gets to pay out. All they need to do is make back the $2,400 they spent. We all understand this so far, right? It's the opportunity cost of just not even having skill. You're just brute forcing such a low risk entry into a profit. How do you manage intraday drawdown at once? Well, there are ways you enter. I'm going to teach you how they do it. I'm going to teach you how these people get $1 million payouts. Yeah, that's the point of today. Now, in company A, you employed the long only strategy at full port, not at full port, but like big enough that you know that the market will move a certain distance. As we know in the S&P, we look for 10 points. In NASDAQ, we look for 40-point moves. If you take the max amount of contracts to get you to your payout goal or your passing goal with just that particular thing, then you are going to, on the first bump up or the first bump down, either blow up or get your profit. So you have to say that like in 10 points, I pass the account. So if they give you 20 contracts to trade with and you have a $3,000 profit target, how in the S&P, every 10 points is 500 per contract. So at 6 contracts, I'll hit $3,000 in a single day. So if they don't make you trade X number of days, or if they make you do and they can let you flip the account, most of these guys will pass their prop accounts at the evaluation stage in a single day. They will load up 20 PAs for the next day. How many of your influencers you see bust, right? And then like it seems like one day later, they're ready to go with funded accounts. Did you know that? You know that, guys? You know what they do? They don't only do this and get 20 funded. They'll usually do this trick and then maybe spend 10 times as much and then actually pass hundreds of them and just only fund 20 of them. When they bust, fund 20 more, and they bust 20 more. You can do that with consistency, Rome. I'm going to teach you how you can. Now, again, I'm not advocating for gaming the system. I'm going to teach you some fundamental rules of prop firms. Now, on the other side of the coin, they can repeat the same thing with a short-only funding strategy against funding program B and play one up and play one down, and the luck of the draw actually speeds up the probability of getting funded accounts somewhere. And they play the long game, they play the short game, and at any given time, you can go out there and spend 5 or 10 grand to go get yourself funded in like 4 or 5 different companies. It doesn't take much at all. But it doesn't matter because you're going to try to aim for 20 and 30 and $50,000 payouts to ultimately make your money back. Now, after taxes, a lot of this is a wash for a lot of these traders. but they trick you into thinking they make these big payouts and don't tell you how much they spend. I know they spend a lot of money on this stuff to do this. But the point I'm making with this is that it doesn't really take a trading strategy to get to making big money with the prop firm. It takes a math strategy, in which what these folks are doing is taking the opportunity of a $20 account for $100, $120 total to get a chance at an account paying you thousands. And if the account's paying you $1,000, only costs you $100 to get into it, then you can fail 9 times and win once and break even. So you'd only need a 10% chance of making that payout. And so the prop firms know that. And because of that, they create rules that keep you from being able to do too much too quick. Now, in certain accounts, when you get to the funded stage, consistency rule is going to prevent you from making it in a single day. But what consistency rules do is they make you trade longer. And let me give you guys 1 second. I want y'all to do me a favor. Smash the like button really quick. We should do contests. But on our stream on Monday, we usually do prop firm giveaways every single day. We give away funded accounts almost every day. You guys have, just this last month alone, I've created, I think, 9 funded traders just by giving them funded accounts. So feel free to smash the like button if you can. Yeah, so it's not trading, it's finding loopholes in the system, 100% right. Now, what I'm not is a loophole trader. I'm a trader that actually trades honorably and consistently. So I actually traded my real account for years. I just started doing prop firms because it's now the biggest thing in futures. So obviously I jumped on the bandwagon with everyone else. But I have historically traded a 70 to 80% win rate. I'm one of the few traders you'll see on YouTube that actually has an actual edge in the market. I do. I have some setups that work 90% of the time. I historically maintain this. This is going all the way back till actually the end of February. So I've been babysitting some accounts since the end of February, Tradeify. And I've gotten over 6 payouts with them. I just started doing it. And right out the door, I'm getting paid out. First 10 days in with Tradeify, I got paid out. So how am I doing it? Well, lucky me, I have an edge in the market and I actually just perform well. But on top of that, if you understand that these tricks and these games people play, there are ways, what they're doing is actually spreading out their risk. They understand that the market is risky. The market is risky, then you have to spread your risk around it. If you were to long in multiple places, even if you longed every 20 points, the S&P would fall, right? Because the higher the market volatility is, volatility just means the amount of Ving in the market, the spread between buyers and sellers. Apart from a low volatility environment, a higher volatility environment is going to give you bigger waves to trade on. If you just spread your risk out, you're going to pass half your accounts. Most of the eval accounts you can pass in a single day. Some of them might have a consistency rule making you pass in a day or two. I think TopStep had one. They might just got rid of it, but had 50%. You can do this in 2 days. But what your prop firm influencers will do is they'll have hundreds of them passed ready to go, and then they'll fund the 20 they need to get on the stream and do it. And on those accounts, what they're going to do is they're going to max out trading all their accounts at once, called copy trading. They're going to copy trade and just go in and try to go in there and trade all their accounts at once with their favorite pivot. Why are they going to do that? At max risk, max exposure at one pivot, long or short the market. You know why? You know why they do that? And why they trade off screen? How many prop influencers do you know? Maybe name some people or don't name some people that somehow are trading one account on stream that maybe busts and blows up, but then on their Twitter, they post, say they're trading like, I don't know, Apex on stream. And then they blow everything up. They traded all their 20 accounts here. They tried to short the market, went against them, they blew up. But then they go on Twitter and they're like, oh, but I made, 60K on my funded account today. How many people do this? But they trade on stream, they lose, but then they're somehow trading some other prop firm off the side and they post that win. They somehow they're trading multiple firms, and they always seem to be posting a win from one of them. Does this make sense? A lot. So they're doing 2 different forms of arbitrage trading. Now, this is what you're going to hate to hear. They're tricking everybody twice. Arbitrage trading. So what arbitrage is exploiting the difference in 2 different markets. Example. If I found a certain thing that I can buy over here for like $1, but I found out that in Japan it somehow sells for $2, then I can buy all of it here and go to Japan and sell all of it there and make $1 each time. I'm just basically getting free money. So did you know they have a free money printing system? Shared funding programs, an absolute free money printing system. So not only is it take a little bit of money to load up funded accounts in like 4 or 5 different firms, but what they do is they max their risk here and trade. Because as a live streamer, I'm going to tell you this. You may not know, but half of you probably follow my trades and trade when I trade. I absolutely advise against that. Legally, I must advise against that. And also, ethically, I think I should never advise for that. I think it's dumb to follow someone's trades, yet half of you guys are going to watch somebody on YouTube and follow their trades and do what they do. Because that's life. Half of you are lazy. It's okay. That's the way it is. You shouldn't be copying somebody's trades on the internet, but whatever. So if I go in full port, max YOLO right here on this account, and I long it, and then I'm going in there and doing the same thing, copy trades and another account and shorting it, not even full port, just enough so that the day's range or that the volatility doesn't blow up the account. Say the example that your average volatility is 20 points in the S&P. So I just need something that doesn't die within 20 points. A position size big enough to get a big gain, but small enough that 20 points doesn't blow up both sides. And in company account A, all long, and company account B, all short, with all of my accounts copy traded together. Okay. As the market is oscillating up and down the 20 points, my position size is such that I don't blow up. Say if you have a $3,000 drawdown and you're dead in whatever account that you're trading the S&P. Well, every 10 points is 500 contracts. So if it's up and down 20, every 20 points is 1,000. So I need less than 3 contracts so that the volatility doesn't shake me out in both of them. I'll long all of them at the same place in one account. I'll short all of them in the same place in another account with another firm, and I'll sit. And then if something happens, all of them make profit and the other ones bust, and it only cost me $2,000 per company to go. Yet I'm sitting on $50,000 in possible realized profits that are only not coming in my pocket because of the consistency rule and the time and market rule. And then all of a sudden from there, I just got to figure out where to go. Now at the same time, arbitrage number 2, because basically they're trading the 2 low risk environments against each other. The risk to reward is really big. Reward to risk is really big. So they're trading short in one and long in the other. Number 2 is when they show you something on screen and that's the account that wins. Oh my God, everybody's happy. Everybody made money. And so I call this influencer arbitrage. They're actually playing you. And the influencer arbitrage side of things is as follows. If they win big, it is hype. All of you won big if you followed their trades. Everyone won big. Everybody saw them win big. They celebrated. The stream was fun. Everybody had a good time. If they blew up, so did half of you. And then at the same time, they're marketing their affiliate code. So whatever $2,000 they spent to long this one and blow up and short this one and win, the one that blew up cost is immediately offset by the 50% of suckers that blew up with them that re-upped with their code. Some of these influencers make more in a week of selling prop accounts than you do in a year of your salary. So the idea is that they're not going to come out and admit what they do, but they found a money printing machine. And I just started giving out my prop codes to people. I never really did this until a couple months ago because it's a money printing machine. I'm not going to tell you how much I make, but it's a lot. It is a lot. I have freaking supercar money falling into my lap every month. It's stupid how much people buy prop firms. So the people that are trading here don't even care if you blow up or not. Their goal is to look as flashy as they can. And when they blow up, they make money. When they make money, they make money. And they're playing both prop firms against each other. So they always have a good one to tweet about that you maybe didn't see on screen, or they'll tweet the one they saw on screen. And therefore, they can't lose. The cost of this is merely a couple thousand, $2,000 to $5,000 a day. A lot of these people are popping 50 to 100K, like, a week. It's not much. And so they can't lose a lot of the times. And if you have and it only works if you have a big enough influence to have influencer arbitrage. You need to offset whatever it costs you per day on these accounts by the amount you make in your prop firms. A lot of these influencers, like I said, will be making, $3,000 to $5,000 at least a day the normal ones will, and the bigger ones will probably make more. Some of them have 20K days in their sales. And the point I'm saying is that what you see on the screen is not necessarily how you're going to beat this program. That's not you. What you see people doing is not you. Number one, I'm going to teach you the rule right now. One thing that I do that completely takes me to payout. I don't play the arbitrage game. I'm trading Tradeify now and nobody else. I'm trading one account at a time and posting one company at a time and posting one company at a time so you guys can follow my journey. My Tradeify payout is, or my goal with my Tradeify payouts is to make 100K and then 150K so I can get maximum $75,000 funded account that goes live, like a live funded account. I already got live funded with the Elite Trader funding. Now I'm going to get live funded with Tradeify, which means they give me real money to trade. I'm so good at whatever they do, they want to give me money. That's my goal. My goal is not to play the arbitrage system. My goal is not to play the arbitrage game. My goal is to maintain a really high win rate, my 75%. This is my cumulative P&L. It's been growing like exponentially since I started doing my Tradeify. You guys remember my couple of losing days in there. And then lately I've just been rocketing up. My goal is different. My goal is to actually beat the system itself and show you guys ways to beat the system. If you don't have, 10 grand to throw at this every week to play the arbitrage game. If you were to trade two firms against each other, one long, one short, and employ a pseudo martingale strategy, which means you're just adding to your risk as it falls, you're not really losing much. And I'm going to tell you why that strategy works for the prop firm influencers, because they make enough money from the sales that it only costs this much to arbitrage the firms against each other. And you're not going to be able to do that because you might not be able to buy 100 Apex accounts in a day, but they will because of the infinite money glitch of them losing, providing the money that comes in their pocket. Did you guys know all of this? It's it's an exponential machine. The more people that watch the stream, the bigger the money is that comes into them, and the more accounts they can arbitrage against each other, the more big payouts. Some of the influencers out there I know are posting, I've got 60,000 here and 40,000 here and 100,000 here. They're getting free money from their sales, and they're going in there and just playing the prop firms against each other. And that's something that you can only do if you've got tens of thousands of people that follow you. It's the same thing as that you can't pump and dump a penny stock unless you have 500,000 people listening to your call outs and buying it after you buy it. There's a trick to using your influence to make money, and a lot of people are doing that. So when I trade, I do it whole. I don't play that game because I don't do the things that they do. Number one, and you'll see me do something different. I don't do arbitrage. I don't trade prop firms against each other. I only trade one firm, and that's it. And a lot of you guys, that might be you. So you're trying to mimic somebody's behaviors, mimic mine. This is what actually will help you. I trade one firm. Number two, I never, ever copy trade. Never copy trade. I never put all my risk in one basket. Why do people copy trade? That scheme was invented by prop firms themselves. Let me tell you something cool. You get a $200 account with Apex, right? Let's make a number, $200 a month for some account. And somehow, okay, and let's talk about this account really quick, right? Let's open up Apex. Let me show you something. Oh, I don't know. Whatever they have. And I'll ask you guys a question really quick. So the Apex 100K account has it's $200 a month, 207. They have a $6,000 profit goal. And they have a $3,000 trailing drawdown. And it's for what they call a 100K account. Okay. So quick question. This 100K account that they're selling you, is it really a $100,000 account? Somebody says TPT is great. You're going to be using them. TPT and Tradeify are the two big dogs in the space right now. I would recommend both of them till the end. Also funded next is a new Forex group coming through, and I'm going to start working with them as well. They're new, but they're moving into futures. They're one of the bigger ones, Forex. Yeah, is this a $100,000 account? Number one, the marketing of you are now funded with $100,000. How many people say like I'm $1 million funded trader? It's all bullshit, right? These are sim funded accounts. Sim funded is not real money. You're not given anything. This is just paper. Paper is fake. They could call this $1 million account. Doesn't matter. It's $1 million account or $1 billion account. Your account is actually this. It's a box that you start at 0, and if you move to minus 3,000, you're out. If you move to 6,000, you're in. It's an account that's basically $3,000. So whatever they tell you the account size is, this doesn't even matter. Never think of it like this. You pay $200 for a $3,000 account. You need to make $6,000 in it to go. So it's really the size of the drawdown that's your account size. But I digress. They give you these big numbers so that it looks kind of cool. And one of the things that Apex will do, and other prop firms will do, is they'll take this number and they'll somehow have like 90% off sales all the time. Okay, so they give you this big fake thing for 90% off. Oh, that's great. It's only $20 now. That's cool. And then they tell their big prop influencers, hey, trade as much as you can, like copy trade. Like they just kind of like handshake it and they laugh behind the scenes, you know. Then we want you to trade as max risk as you can and put them all together. Put all your eggs in one basket. Because I told you earlier, if you were to just long as the market was falling and spreading out your risk, half of your accounts would win. The chances of you picking a spot with all your accounts and winning is very low, especially if you don't understand how volatility plays into the market. Even if you were to long and short and prop arbitrage against two firms, if your position size was too big, the choppiness would blow up both of them. So you'd have to make your position size small enough to avoid the chop. You guys don't naturally know how to do that. I'm going to teach you in this course today how to do it. If your position size is too big, the chop's going to blow you up. So the chances of you putting all of your accounts in one place and getting the trade right is practically zero. They know this. The way that they pull you into this addictive system is they sell you the $200 account at 90% off for $20. Okay. And it's a fake account that doesn't mean anything. It is a big empty box. It is a $3,000 account, right? We already determined that. And then they told you you can buy 20 of these things because you're like, oh, I can buy 20. So now you paid $400, but you didn't pay $400 for a $60,000 account. You got 20 accounts of 3,000, and then they tell you you can copy trade, and your influencer's copy trading and trade them all together. So now you spent $400 on 3,000 times 20, but they're copy traded. So it's actually not 60,000. It's again 3,000. Because if you're trading them all at the same time, your limit is still the same for twice the price. It's the biggest marketing scheme ever in trading. They had a price for something, $200 for a $3,000 drawdown, that they convinced you dumminess to buy it for twice the price. That's exactly what they're doing. Do you guys see this right now? We all understand this so far? The 90% off and 80% off sale, but have you buy 20 of them and you copy trade. You just went a big circle in back where you started. One account at $3,000 drawdown that you just paid twice the price on. Everybody here? Yes, we understand that. It's ridiculous. And the prop influencer doesn't care because the more that you tether your accounts together and blow up, the more you use their code. I aim for R&R on my trades. Always R&R. I have a 90% setup and an 80% setup, and I aim for 1-to-1 and 1.5 to 1 trades. I make a living off of 10 points in the S&P and 40 points in the NASDAQ. I think on yesterday I made like 8,500. The day before I made like 12,500. This is just trading each of my accounts separately. But I have an edge. I have a genuine edge in the market that's different than most traders. I have something that works really well. How you pay double the price? Because if you buy something at 200 at 90% off, it only costs you $20. And then you bought 20 of them because you can buy 20 accounts. And then now you spent $400. You bought a $3,000 drawdown for $200 and 90% off. You bought it for $20. $20 for $3,000 drawdown. And you bought 20 of them. So now it's $400 for $3,000 drawdown. Because you're trading them together. If you're copy trading, you basically pay double the price for your thing because your gambling addiction is going to have you taking max risk and going max port everything that you could. You see it yet? Okay. So the idea that you can copy trade doesn't give you additional risk for the additional money you paid. If you copy trade them together, you still have $3,000 drawdown at the same spot if you traded them all at the same place. And they're expecting you to, because they're going to tell the influencers that volume is what's going to give them more salary. I've been offered salary from prop firms. It's substantial. I'm talking substantial. It's 6 figures a month, substantial. I'll go over the edge in just a little bit. And they tell you, I'm going to give you X money with this amount of people, and I'm going to give you X more money with this amount of people. If you sell this much accounts, I'm going to raise your salary. If you sell even more, I'll raise your salary more. So the prop firm arbitrage influencer now knows their goal is to get as many people to blow up as possible and get as many people addicted as possible to keep that machine churning money for them. So of course they're going to copy trade. It's an unspoken rule that some smarter prop firm influencers figured out, and then we all kind of figured out around them, is that they will display max risk on their stream. Therefore, it's max blow up and therefore max salary for them from the prop firm. Are we all on the same page so far before I go forward? And I'll tell you the edge that I use in just a little bit. It would kind of be like, unethical for the prop firm to say, hey, why don't you convince everybody to blow up? But they don't, but it's kind of understood. I'll give you double the salary if you double your sales. The prop firm person goes, oh, let me just bet as big as I can. I've got infinite money to play with. If I blow up, then they blow up more. And then I sell the code after we all blow up. Or if I make money, then my influence grows bigger that way. So either A, I make the money in the trade and then I get bigger from promoting a good trade, or I blow up and make more money and they get bigger in the prop firm side. And so people are growing their influencer base that way by trading multiple firms and posting the winners on Twitter and then blowing up on stream and developing a community around themselves. And everybody goes, oh my God, they're so transparent. They blow up on stream. And oh my God, I love that they show their losses. And oh my, that is a design system where their paper trading losses make them money. It is a ridiculous world we live in now, but that's what it is. But you'll never make a dime. That's the thing. You will never make a dime because you can't do what they do. Okay? It's like the crappy part. You can't mimic it. The only way you can mimic it is to hustle out there in this competitive space and try to build a name for yourself and build a following. And if that's what you're trying to do, then you can. But if you're trying to be good at trading like most of you, that trick won't work. Okay, so the whole Apex thing, the example is they sell you something at 200, then they decide to make you pay double, and you will pay double because you're jumping into a system. If you're buying 20 accounts and tethering together, you're just paying more for one account. We all understand this, right? So if you're going to buy 20 accounts, don't tether them together. Instead, split your risk up so you have a better chance of beating the house. If you have 3 or 4 bull entries, split your accounts up to trade at each one of them. One account here, one account here, one account here, one account here. Imagine you have 5 different good, long, strong pivots, and you're so bullish in the market, and the market's volatile, yet you don't know which place it's going to land and pivot from. Let me give you an example from the market's closed, so I'm going to be able to show yesterday's maps. Let me see if I have it cached from QQQ. We don't have yesterday's maps. Okay, so what I'll do is, let me just click on S and we'll just use futures. As an example, let's put in like NASDAQ futures is a big spanning volatile range because, we are trading in a volatile environment. There's trade wars, everything. And as long as you are, in this market, the volatility is going to crush you in most of your trades. I mean, that's kind of the problem. Or a random Trump tweet or somebody will say something and the market just flies against you. So in that mode, it's better for you to split your risk up and trade at each one of your entries because your cost of how much you spend and how much you get paid out is lowered. So in the prop world, you have a metric that you should also use, just similar to the influencers, but this is how it works for you. Is how much you spend is a business expense. You're going to spend a certain amount of money. The prop influencers, I'm going to tell you, it's going to sound staggering. I know somebody who spends $100,000 plus a month on prop firms. See, you might sit here and go, God, these prop influencers are all fake. And then they're like, no, I'm not. And they're like, yes, you are. And then on Twitter, they're all fighting each other. They're not fake. If you get them all in a room together, they all laugh at how fake they actually are and how much they milk you of money. Like as a comedy. Like behind the scenes, they all know it and they all kind of share with each other. Like, this is how we do it. This is funny. Oh, that's funny. I do that too. It's not a clean place, the prop world. They all know they spend a shit ton to make a whole lot, but they all know that it's legal and it is part of the business. I mean, the part of the business is you're milking the firms of money. And the firms have been battling the influencer arbitrage game for a while because they had to keep like making rules, consistency rules and minimum days in the market rules kind of thing, so that they can eliminate the idea that, or to make it really hard for them to do so. Yeah, so behind the scenes, everyone laughs how much money they make. It's ridiculous. They all talk about it, brag about it. On the surface, they're like, no, I'm a real trader, I'm a real trader. But that's just so you keep watching the show. And the goal is to keep you watching the show. Okay, so spend and return. For you, you need to make sure that you return more than you spend. And that's kind of the part of this. Now, your returns that you get from a prop account, remember, until you go live funded, you're actually making money off of what we call the... you're a consultant. You're basically, the way that you get paid in these sim-funded accounts, which is the paper trading account that you get paid from, is that you're an actual consultant to the firm. Your trades is market data for them. So they can pay you money for providing the market data. It's a big loophole how you even get paid sim-funded anyway. So you're not really getting paid as a trader. You're actually getting paid as an employee. You're getting money on a 1099. You know anything about taxes, a 1099 is general income that comes in from working. And so this adds to your the total line of income you have. So this is taxed at the max. Your income comes in and moves you up the brackets, and this comes in right on top. So let's say that you're maxed out on taxes. You're already going to lose, what is the max, 37%, whatever it is, off the top. So it doesn't matter if you made $1 million, you're walking away with 600K. Already after taxes. It's like a game show win. You won $1 million on Prices Right, and you won 600,000, right? You're going to get taxed, number one. And also, you're going to get a profit split with the company after a certain amount of time. You're going to start losing like 10% of what you make. Now, in the sim-funded world, it's weird, right? Because how are they profit splitting with you? You're not even making anything. No, they just give you a 10% haircut because they want to. It's part of their risk model, right? Sim to funded, you get, even Tradeify does this. And the sim to funded, straight to funded account, it's a sim funded account. And they take 10% of all my payouts. My $3,000 payout for each account was $2,700 net. After taxes, I lose even more of that, 60% of that. So is what I keep. So the 10% they take off is just a haircut they give you. It's not real money. It's money they just don't owe you. And so you didn't make anything because you're not really trading. Here's your split. Okay, so you have a split, and then you have your cost. And the spend to return rate, the return to spend ratio is going to balance the rest of this to cost you actually make money. And if it costs you, let's say that you lose another 10 to 20% in fees of resets and prop, eval accounts and whatever, I'm just calling it your fees, right? If you spent $1,000 on the accounts to get a $10,000 payout, then 10% go to the fees on top of it. So your take-home pay from all of this is not much. Like, Jade Cap's about to pop out a $3 million payout. He's probably going to come in at just over $1 million net, which is still good. It's still profit. It's still effort on the return. And he's only been trading for since January. And I love Jade Cap. He's great. Good trader. And so, but the return is not as much as you think it is. And he's not like everyone else. He's not like streaming his stuff. He's different. He's actually not doing the arbitrage game. He's been committed to one firm. But at the end of the day, you can see how you're losing like greater than 50% of what you make, right? It's automatically leaving the door. Maybe upwards of 50 to 60%. So whatever you make, your $100,000, or every trader makes $100,000. They're walking home with 40. That's it. So somebody streams for a month, makes $100,000 payout. They walk away with $40,000 from the prop firm. Check number one, or check number A. Check number B is they're walking away with $400,000 from the same prop firm by selling the prop firm stuff. You thought they made $100,000 payout. They did. They actually made 450. Well, this also will be taxed too, but that 400 actually becomes 200. So yeah, they're a lot of these prop influencers are making ridiculous fortunes from the prop firm after taxes, but the payout portion is such a significant smaller portion of their income. Did JCap get paid out yet? I don't know. I haven't been. My computer's all busted on the floor. I took it out and took it apart. So I haven't been following the Twitter saga, but I think on Friday he requested his payout finally. So let's hope he gets it, right? Because, Apex has been getting a lot of heat lately. Okay. So anyways, you guys understand that the whole system of what you watch is just basically designed to not care if you lose. Are we on the same page there? Now I'm going to tell you how to win. Despite all that. You guys understand what I'm saying, right? The system that you're watching is not something you should emulate. You're watching people pump and dump their favorite penny stock, and you're the sucker that goes in and buys it. They're making the money, not you. It's a pyramid. The people at the top of the pyramid with all the influence make all the money. Okay. And so that's what I'm trying to basically say. And the unspoken rule is that the more sales they do, the bigger the salary they get. And it's win-win for you. Again, I'm going to repeat. If you blow up 20 accounts at once, so does everyone else, and you make a fortune from the sales. If you spend all your money on an account and you make a whole lot of money, then you get a big payout, and you can brag on social media about that, and you might get 20 more people watch your show tomorrow to jump into your addictive loop that you've made. And it's a very cool thing, and that's what everyone out there is kind of doing. Now, I don't do that, but it's an infinite money glitch, and I don't think it's going anytime soon. What you have to do is you can't go learn from these people. Don't at all buy their course. You're ridiculous if you do. Some of them are teaching courses, running Discords, whatever. You're not going to learn what they do. It's just like a pump and dump penny stock room. Hey, join my Discord. We teach. We're going to teach trading. They're not teaching you trading. They just want you to buy the stock after them. These guys just want you to blow up. They don't care if you do. I sat there and watched my stats on my own sales. And I don't even do a lot. And I still make a whole lot of money. My stats have gone through the roof the last 3 weeks. Why is that? Well, the last 3 weeks, the market's been crashing. On the days that the market collapses, even though I'm not blowing up, there are still people that are blowing up, right? All over the place. I have, on the days that we're getting circuit breakers, I tripled my affiliate sales that day. The first moment somebody sees that, you just have to be not like a paint chip eating moron to go, oh my God, there's something here. Anyone can see that trend. Holy shit, when markets are crashing, I'm not making a lot of real money in my trading accounts because I'm not trading a lot. But man, I'm banking in the prop accounts. You know what I mean? So the idea is that once they all saw this, they realized I can't lose no matter what I do. So here's a good trick. As markets are crashing, why don't you do this? As a big influencing trader, buy accounts, of company A, company B, company C, and just as the market's falling, you're going to long in count 1 and 2 and 3 and 4 with company A, and market's going to keep falling and keep falling, keep falling, keep falling, keep falling. Go to A, do all 20 accounts in B, all 20 accounts in C. It's like a martingale. Just keep adding as the market's falling. Post your winner on social media. Take that to the funded route. Blow these up. Everyone's blowing up with you as the market's falling. Longing in a bear market. Eventually you'll make money. But as people are blowing up with you, you're making more money. It's incredible. Yeah. So, like I said, somebody said, you're not going to be able to do this. And the trick is to always give you the impression that they're transparent. And that's the sad part. Yeah, they are transparent, but the transparency is what's paying. And they're not transparent about the business model they have. They're transparent about letting you watch them lose. And that's okay because losing makes money. We've already determined that. You're their liquidity. Yeah. Okay. But is the review function on the course disabled, or you need to be Pro Plus to leave a review? No, you don't need to be. You have to go to my purchases and it should leave a review function. The leave a review is there. How many accounts I get a sales credit a month? Curiosity. Alpha, can you rephrase that? I don't understand your question. So what you guys are going to want to do as traders is number one, is never copy trade. This is rule number one to making it here. And my Tradeify accounts, the 5 accounts I have now, aren't the same 5 accounts I had in February. I'm sure I've rolled each one of them over at least once or twice. I'm not trading in account number 500 with those guys. They're still in the double digits. But what I'm saying is I'm trading in 5 accounts, and 4 of them might make money one. Or let me give an example. If the market's really crazy and there's a lot of risk, I might choose to just trade in 1 account instead of 5. If 1 account takes a loss, the other 4 are there to buffer. If I'm trading a bunch and the market is falling and I'm trying to aim at 3 different long pivots, I'm going to trade all of them. Say I have a long pivot option there, there, and there. Well, instead of taking my 5 accounts and just picking which one and putting all 5 at them, the trick that I do is I spread my risk out, which is, if you think of everything I'm going to say now, think of the opposite of what the influencer was doing, or in the earlier example. They're trying to get you to consolidate your risk for maximum exposure, maximum blowout potential. So you do the opposite of that, spread out your risk. Trade 1 of your accounts here, trade 2 of your accounts here, trade 2 more of your accounts here. If I do all of this and 1 of them just happens to blow up, 2 of them take a loss, the other 2 take a win, ultimately, my cost of that is I have to pay to re-up 1 account. 2 of them live to fight another day, 2 of them put a win, and maybe the win was bigger than the loss, and overall the net was a win for the day. If you treat your overall gain with the prop firm as your overall account size, and that's a win for the day, it doesn't matter if you won in 1 account or 4 accounts or 0 accounts. As long as you won for the day, it's all that matters. And as long as what you spent was less than what you won for the day, then you're profiting from the endeavor. How many accounts to buy using my code? Like I said, dude, we pull in like 6 figures a month, and we just started. So, but what I do with the money that we make is I buy you guys funded accounts with it and give them away every day on the stream. I've convinced the prop firms to give me 40 accounts to give away every month between a lot of the majors. And then with the rest of it, I go out there and I buy prop accounts to give to you guys. So from that, and this is not including salary, I've been offered 6-figure a month salaries. I'm being offered 2 salaries right now by 2 prop firms. It's crazy. Salary, just a base salary. Here's a salary, by the way. And so there's enough money to go around in these firms. And I'm one of the smaller ones at 6-figure a month. I'm one of the smaller guys, trust me. But what I do with it is we try to stimulate, giving back. We give out a lot of Rocket Scooter memberships. We give out a lot of stuff. Every day on the stream, I do giveaways. We'll do prop firm giveaways every day. And I go out there and I'll buy funded accounts for you guys. These things cost a couple $100 each. So, and then we take the rest of the money that we make. And so I'm the CEO of the company Rocket Scooter. We're a trading platform. And so I take the rest of the money that I make and it comes into the company. And I just basically pay the employees' salaries with it, develop more stuff with it. So when you guys support us, you're not out there buying me Lambos. You're actually supporting the development of a trading platform with some really cool stuff in it. So we're continuing to develop the platform, and we're using, the money, not the money glitch, but the money printer, I'd say, of the prop firms to actually build something to give back to the community. So that to me is what I like to do with it. I actually do very well trading. So what is a profiting endeavor to be part of the prop industry? It definitely is good for me and better for me to, create something with that money instead of just indulge with it. Like I said, I've lived the rich lifestyle for many years. I have all the cars, I have all the house, I got all the girl, I got everything. I get the bottle service, first class flight level life. Okay. I've already been there, done that. It's boring to me. It's not the fulfilling part of my life. And a lot of these people are like, they make their first money and they're going to buy a sports car. I mean, I remember when I was in my 20s too and young, and that was exciting to me. Now I've owned Italian sports cars all my life. And yet you don't ever really see me tweeting pictures of them or making that a focal point of my stream. It's not really something that it's exciting to me. It's only exciting to you if you're new to it. And I can always smell new rich from a mile away. Trust me. When I walk up to a club, they park my car. The doorman lets me walk in because he knows me by my first name because the week before we spent 50 grand at a party. And this is what it's like. But yet you don't know that about my life because I don't out there in front it because it's just the normal part of our day now. It's not ooh, look how cool I am now. Everybody watch me and look how cool my life is kind of. That brings sales to you. People see that trader porn lifestyle and they love it. And so a lot of people are still in that mode of I want to make money, indulge it myself. And, that's totally cool and it's all power to them. But what it does is it gives you a false sense of what you can achieve in this world. It's not really what you're looking to do. You know, once you make money, I know a lot of you are probably very wealthy. Once you make money and make a lot of money, the last thing you're going to go do is go brag to everybody and tell everybody about it. Like I said, when I go to the club, I can smell new rich from a mile away. Guy walks in, you know, with a grill and a chain and a Rolex and got expensive this, Givenchy everything, you know, like whatever he's wearing, everything, and just looks rich. Like everything shining on a dude walks in the bar and you're like, I know this guy's trying way too hard. You know, the richest people I know will walk in the, you know, a store with Crocs on and basketball shorts, you know. When you make a lot of money in this world, the last thing you're going to do is brag about it. The more people that know about it, the more people are going to take it. The real rich will tell you they're as quiet as can be about the money they make. So another rule of thumb is just to note the louder somebody is, either the newer they are to the wealth game or they're just ignorant to understand. They've never played the game. The richer you are, the less people are going to tell. I'm so shy when I go to people's houses. I'll park down the street. I don't like walking up and everyone's like, oh my God, check out your car or whatever. I've always been shy and timid about sharing wealth, other than going out and having a good party one thing. But when my friends get together and they're all very wealthy, the last thing everybody does is talk about, you know, the new airplane they bought. One of my friends has so much money, he has a tank. He bought a giant car garage that holds all of his sports cars. And he just bought a tank, like a real tank. You can drive it around. It's incredible. Like, and then of course, you know, they'll brag, I just bought a tank or whatever, but it's not like, you know, these guys are stupid rich, and yet they don't walk around and you would know it. They're not posting on social media how rich they are, kind of thing. Or would you drive a tank around? Yeah, like for publicity stunts. He does it now. Like he's a doctor, but he does it for publicity stunts. So people like hire him in his tank to come at some event, like they're opening a new something and the tank is in the parking lot. It's so fucking hilarious to see him do it. So he drives up in his tank and it's just sitting there. Yeah. But anyways, okay. So just be careful out there. The impression, the illusion of rich that comes from big proper and payouts, that comes from, you know, copy trading and all this stuff is not really where you're going to make your money. You guys are in a different boat. And again, I'm not knocking it either. Don't think I'm throwing shade at my friends. If I were to walk up to every one of these folks that do it, I'm going to pat them on the back and just be like, that's pretty impressive. You figured out the system. I figured out the system. I just don't do it. But I wouldn't ever knock somebody by legally making money in a good way. Everyone out there is hustling to make a living. And I would probably sit there and laugh with them about how dumb you guys are. I mean, that's kind of what it's like. And so just remember, in the prop game, you don't win this way. The way that you win is a little different. Okay. So, hey, Matt, I know you make money. Question, how much your members are making. I don't hear much about them or how they're doing on your stream. There's a P&L channel. One thing that I don't do is I don't really kind of like spend a lot of time bragging about how good my traders are. A lot of people that do well that run groups or run communities really love to parade or tweet about their best winner or their best whatever. This guy made a payout, this guy made a payout. It makes them look better. I actually don't at all. I'm so different when it comes to everybody else in the space. I don't really look. I don't even care. I care that everybody does well, but I don't even pay attention. But it looks like people are posting their stuff here. And you can always go back and see what people do. I have hundreds of people paying out, funded, whatever. It's all here. Rich trader. Daddy Rich, only Evans posting, Futures Trader. I mean, look, you can go on the P&L channel and everybody's just posting what it is they do. So I've got a lot of people in our group. And in the Rock Scooter group, I've got 2 really famous celebrities. I've got a bunch of athletes. I got a bunch of people that are like really, really rich that are trading that you wouldn't know who they are. And I can't tell you who they are. But like, you know, it's funny who's a day trader. It's kind of like the craziest thing. So there's a lot of people that do very well, I'm sure, but you'd have to ask them, of course. But most of your people that run rooms are going to tell you, oh, I got a ton of millionaire traders and this and that. But I'll tell you, I think of all the groups out there, I think we produce more winning traders than anybody. High win rate traders. The loyal following we have has been just killer. We have 0 bad reviews online, literally 0. I've been in business since 2016. There's not a single bad review about what we do. And it's weird, right? You think that after 8 years of people sucking, somebody would go out there and say something. Well, they haven't. And that's good. It makes me feel statistically that we're probably one of the better ones out there as far as producing winning traders. Now, I'll tell you, everyone here has their own opinion. And I don't like to use that as a sales point. I think that's kind of silly when people also do that. I probably could go to the P&L channel and grab, oh, this guy made 100K this day. One of my traders had $1 million options play earlier in the year. I can probably go take pictures of that and tweet it and grow my sales. But I always found that to be a little dishonest, right? Not really what my goal is out there. To make that a focal point of mine is how much of my members making. I kind of go off the feedback of the reviews and try to tailor stuff based on the merits of its own self, like how good is the course and how good is the material. If they all were banking nonstop, you'd probably be banking 6 figures a month in referrals. Well, 6 figures a month in referrals is actually really small compared to the prop game. The referrals come from the YouTube stream, not from the inside the community. The YouTube stream gets 5,000 views or 5,000 views per day. You know, those are the people using the prop accounts. I call you guys, tourists. Y'all just come, check out the stream, use the code. I wouldn't say that's people in the service. But in either case, everyone blows up in prop accounts. It's not because they're good traders or bad traders. Everyone blows up prop accounts because the prop firm industry is designed to make you blow up prop accounts. It's part of it, yeah. Yeah, most like to brag about winners, even though they may be losing on the side. Yeah, right. And so, in general, we make most of our money probably from the tourists, the people that just kind of stumble into the show, but aren't really part of the community. Is traveling through YouTube, just hanging out, different, testimonials help. You believe it's important, you'll check it out. Yeah. Okay. Why the chart's not moving? Oh, the stock market's closed. It's a holiday. Yeah. So, and at the end of the day, I would say that I think that we probably, because we actually teach a bunch of substantial things here, that the things that we do teach, I think produce better results than other people that teach on YouTube. And a lot of the setups, and I'm going to talk about my setups now, that I do use are very high probability. And that's why my win rate has been what it is, even in this environment. So I trade 75% win rate since February in this Tradeify world. In the funded account world where it's harder. Now, how did the funded account, how did the prop firms make it to where you lose more? Not only do they get you to maximize your risk by following an influencer, that's number one, they use the influencer as a way to squeeze you out and lower their risk. The more you blow up, the lower their risk. So they know influencers are going to get you to stimulate you to trade more and blow up more. They know that copy trading is going to make you blow up more as well, isolating your risk to one spot. The chance of you picking the right direction in the market is very low. And they also punish you for multiple things. Number one is you can't lose too big, right? Lose too big, then you're out. Your market's going up, you hit your trailing drawdown, you bust. Well, that sucks. Number four is they're going to put in minimum number of days, okay, min days. In the prop risk space, they call it TIM, time in market. But time in market actually is a statistic. See, there's this kind of mathematical thing called the law of large numbers. And the law of large numbers states that the more data points you have of a set of data, the more likely it is for the result of whatever it is inside of that data set, whatever game is being played, to revert to the mean or the average of what's expected. An example is if you had a grid, I'm just going to draw a grid right here, and somebody were to say, what color is in this grid? And inside of this grid, you saw there were a couple of blue dots spread out through here. And then also in this grid, there was like a yellow dot every once in a while. And somebody would say, what color is this? And if you were to say, what color is that? You'd probably say blue, right? But then if I put more data points in there like this, you might say it's yellow. And then I put more data points, there's blue. And then I keep putting more data points and more data points. All of a sudden it starts looking green because yellow and blue make green. So the idea is that the more data you have in a set, the more that what's really there is going to be revealed. The other way I used to describe the same metaphor was if you were going to play LeBron in basketball one-on-one. chance of LeBron beating you is every single time. The only way you'll ever beat him is a fluke. And so the only way you can win is to hope you get that fluke. And the small chance you get it, you get the ball and he says, you can make the rules, play me one-on-one, but I'll let you make the rules. You say, great. We play to first basket wins and I get to shoot first. Okay, that's the rule. And that's your only chance of winning, because if you play 100 normal games, you're going to lose 100 times. Very rarely on a game to 10 of one-on-one, you'll ever beat LeBron or even score a basket. But you hope that in the first time you get the basket, you make the basket, you won on the fluke. The law of large numbers states the more you play them, the chances are your ultimate percent, your winning percent is going to be the realized mean that the average of games is that you're going to lose almost all of them, right? So the more you do anything, the mean is realized. Well, the mean is realized this. Trading is a thing where you don't have a statistical edge at all. As market makers are finding liquidity in the market, as we prove in our rocket scooter teaching, the maximum liquidity in the market is where buyers and sellers are most consolidated and at the most stressed point. The maximum squeeze of anybody. Well, example is a market maker is someone that's providing liquidity on the other side of your trade usually. And if you're making money, they're losing money. And if they're providing liquidity and everybody's losing at the same time or equally at the same amount, then their risk is minimized. For a bunch of traders to be making money, then a bunch of market makers need to be losing money. But somehow the banks are always making money and you're always losing. So the banks, the market makers themselves are always minimizing their risk at all times. So by them minimizing their risk, traders themselves are maximizing their risk. So you are always playing against a game where dealers are just neutralizing all their exposure to the market, meaning they have almost zero risk. Okay, that is actually the zero-sum game of, the law of large numbers states that over max amount of trades, the market makers will likely have zero risk. And for you, over max amount of trades, you're going to have max risk. Because somebody has to have max risk for someone to have minimum risk. There's got to be a trader on the other side of every trade. So the longer you're in the market, it doesn't matter if you want to trade every day or 2 days, but if you're trading 100 days, ultimately your law of large numbers will say your max risk was realized and you go to zero. Time in market is a graph that looks like this. Your probability of winning decays logarithmic or exponentially the longer you're in the market. To where statistically you go to zero. Statistically, everybody will go to zero. That's the stats of the market. You may make some money over time, but over time you ultimately go to zero. How many people feel like you always go to zero at some point? And don't worry, that's not a testament of us sucking or you sucking. That's just the math of the market. Do we get that so far? That's most people, like every day. You feel like the longer you're in the game, the chances of you going to zero is higher. And the minimum days trading rule is designed to exploit the law of large numbers. It's to keep you in the market longer. The longer you're in the market, ultimately, the minimization tricks of the market makers, they have inside information, they have order flow information, they have the money to to offset their risk and things like that, ultimately drive you to maximum risk. And you might get luck in short-term bursts, like a couple winning trades or a couple winning months, but ultimately over time, LeBron kicks your ass. Okay, the market is LeBron in this example. So time in market is probably the most severe rule that's never talked about. Everybody always goes in and attacks like, oh, the trailing drawdown sucks, and this rule sucks, this sucks. No, the rule that is the most important rule is time in market. It is. And nobody talks about it because, nobody's a math person, I guess. And by the way, if you guys don't know me, my name's Matt Coward. I'm a mathematician. I have a chemical engineering degree. I went to university to study reaction engineering, and I worked in chemicals for a while, designing chemical reactors and doing mathematical modeling and reactors. It was like my whole life has been math. And then I moved to trading in 2010. I was your little gifted math nerd as a kiddo, and now I'm applying it in the stock market. So all I think about is math and stats, and this is a little different than most traders. But this is what I see as a mathematician, is that the time in market is the worst enemy that you have. If there's one company that sells an account for $100 and they say you can pass in 5 days, and a company 5 days for $100 for the account, and another company offers you an account for $50, but it takes a 10-day approach, you might say, well, that's a wash. One is twice as much for half the days, and that's the same. But remember, your time in market is like exponential. It's if every day is a coin flip, ultimately you're going to lose. Then it goes from 100 to 50, or say it's like one, your odds are this, like 1/1, 1/2, 1/4, etc. The longer you're in the market, this denominator compounds. It creates a graph that looks like this. It's not a linear relationship. If you were to choose A or B, which one would you choose between the two? One that costs $100 for, you have to pass, you have 5 days of trading for $100 and you pass. The other one says, we'll give you 10 days, but make it 50. Which account is better, A or B? This is the choice you need to make with your money. A, hands down A. Absolutely A. Because it's not a linear relationship. Every day in the market cuts your chances of winning by like another half. It's another game you got to play LeBron. It's another day that the odds are staggered against you, right? So the idea is that basically you're going to always want to pick the one that is the quickest turnaround to pay out. The longer you're in the market, 100% is going to be the enemy to your trading. You don't want to be in the market for many reasons. Number one is you may or may not have a good trading system, but hell, even being in the market, Trump can tweet something and blow you out. The prop firms know this. They want you in the market as long as they can. Is there any other industry out there that has a time in market rule that their entire business model is designed to keep you there playing the game as much as possible? There's a whole science to the psychology of what casinos do. Time in casino, time in market. When the odds are against you, the law of large numbers makes the house win. The odds are absolutely against you as traders. So if there's a a funding program that wants to keep you in the market longer, realize that the cost does not scale linearly. It should be exponential. Something that is 10 days versus 5 days should be $10 to offset the cost of the risk. 1/10, not 1/2. It should be much, much, much lower. It's half of a half. Actually, just think of it like this. If every day cuts your odds in half, this should be cut in half 5 times. 50, 25, 12.5, 6. This should be worth $3. If trading was quote unquote a coin flip, every additional day reduces your odds, right? Cuts your chance of winning by a half of the previous day. So therefore, the cost should be cut by half each time. Just 1 day longer should be half the price. If something was 5 days for $100 and somebody says, I'm going to give you 6 days. If it's not less than $50, you're not gaining value on that. So rule number one is the time in market is when you're comparing costs between two firms, the more expensive or each additional day should be half of the price of the previous one. Their risk model is all designed in a way that they're gonna benefit from a certain loss rate of traders. And the reason why the casino model is as such, because it's a business. The model is a very simple energy balance. There is what goes in minus what goes out equals accumulation. We all remember this from physics or whatever, right? So whatever money comes in from the losers, paying out the winners, whatever is left over that's accumulated, minus the overhead of running the business equals the profit of the company. You can't profit without out and accumulation being greater than what comes in equals out plus accumulation. So overhead plus profit plus what pays out is equal to what comes in. So therefore, what comes in must be greater than what goes out because you have these things to account for to keep your business going. And if somebody's making a profit, then there's more losers than winners. Period, because that's where the money comes from, the losers. All right, so for just in general, in a risk sense, an extra day in the market is another coin flip that you lose. It's not $10 of benefit to you. It should be about half the price, give or take. Now, they're not priced accordingly because they're not going to really, everyone I don't think even is aware of that being, like, even the props themselves, they should know that that's the rule. But if you find somebody that gives you turn your account around in 2 days, and if all the prices were the same, if every prop firm price was about the same, $100 to $150 to $200 for X amount of days, for X amount of account size, then it's the one with the minimum days to pass is the most important one for the value. Even if it's $150 instead of $100, pay more money to have one fewer day in the market. I promise the odds are in your favor there. So the way that, again, the way that they're going to try to beat you is try to keep you in the market longer. Okay. Rule number 5. So the first one I talk about, losing too big. These are ways that they squeeze you, losing too big. The way that they get you on losing too big is they give you max amount of contracts to trade with. Now, I'm just going to pull up an example. Apex, as I have front and center here on Apex. And Apex is one everyone's familiar with. Apex. Right here, they have their 100K 14 minis for $3,000 drawdown. Let's do the math of that. 14 minis for 3,000 drawdown. So what they do is they exploit the fact that you have no idea your position size and risk. Now, I'll tell you something neat. Let's use S&P as an example. On Rocket Scooter, we give you a number called the risk interval. And right now, it's close to 60 points. I'm going to say 60 points over here. 60 points is about how much the S&P is going to move up and down when there's a news event or like the max spread of risk just in any normal day. 60 points is pretty normal. And as you see, the risk interval is going to be very tied closely to like the range you'll see in big runs or ups or downs. You can see about here, 53, 57, to right about 52.85. It's close to that 60-ish points roll. It's pretty how the market ebbs and flows in that kind of volatility. So let's say that 60 points is about what to expect if you were to long at the high and take a loss or short at the bottom and take a loss around that 60-point level. To get the $3,000 on one S&P mini, it's not hard at all. As a matter of fact, to lose $3,000 on 60 points, 60 points per one contract is $3,000. That's actually $3,000. Just one contract on 60 points is going to lose $3,000. Yet they give me 14 to trade with. See, the fact that you don't understand how much or the magnitude at which the market moves, they give you too much fire to play with. If your drawdown's only $3,000 for your 100K account and you can trade 14 minis, Matt's going to tell you you should be trading one. You're going to lose too big because you bet too big. And that's one of the biggest problems that trader funding programs don't tell you. They give you more than you need because you're going to use it because you're kind of dumb. You should trade one contract in this event for 60 points up and down rather than 14. 10 contracts, you'll bust in 6 points. Yeah. Isn't that crazy, right? So the thing is that you're going to lose too big because you bet too big. So number one is they're gonna know that you bet too big, and one of the tricks they do is they give you too much to trade with purposefully, and that's just, again, they find all these ways to kind of make it harder for you without you even knowing it. So that's kind of neat to see, right? They give you much more than you need for a $3,000 drawdown. So your lack of understanding how big that is one of the ways it gets you, right? You don't know that that's way too big unless you do the math. The other thing is you don't know that every day in the market's going to reduce your chances by half. Okay, they don't know that either, so they'll keep you in for longer. Consistency rules. So actually, let's talk about drawdown rules. Trailing drawdown. A lot of them have trailing drawdown, which means as the market goes up, if you don't just take profit at some arbitrary high, you're now losing and possibly blowing up the account, because a trailing drawdown is going to tail with you as your profits are going up. And even if you made 10,000 for the day by going up 13,000 and then falling to 10, you died on the trailing drawdown. Even though you made money, you lost. Because for some reason, trailing drawdown is a rule that makes you guess at a high. Or you have to get out of the way, and you can't even just hold a trade. They make you guess at a high, like you have to close out at an arbitrary high so it doesn't draw down $3,000 worth of drawdown. So they make you guess at a high, or they challenge your discipline, because you might just decide to hold on. At any point you're riding along, a random move can blow you up, even though you're winning. You can't just sit on a win. You can't allow luck to give you a win. any market moves up and down, and the ups and downs can be what gets you. Hell, if your position size was big enough and you longed right here, this could have actually blown up your account. Real trading accounts don't do this. So trailing drawdown will challenge your discipline. They make you get in and out faster. They make you close at a high to make you leave trades early. If the market wants to run straight up, they would lose a fortune. But because you can't hold all day, because markets don't run straight up, they chop around a lot of the time, they make you close your trade early, and that's the trick of trailing drawdown. They make you guess at a high, and they make you close early. That close early is the scheme that you didn't realize either. You get it? Close early. Shit, I'm in the green. I got to close. Because if I take $3,000 of trailing drawdown, the trailing drawdown is going to get me. Does that make sense, you guys? They make you close the trade early. Market bumps up. You got to close early. They're like, how do we keep people from making more money? Oh, let's make them close their trades early. Because they're scared of trailing drawdown. Market moves up on an event. You're probably going to be smashing the close button while it's green. You're not going to sit on that trade and ride it, especially if you're betting too big. So a lot of people are betting too big. The volatility gets you. The trailing drawdown is designed to make you close too early and to make you afraid of winning. That's really what the fear is. So the risk model is they make you afraid of winning. Afraid of big wins. They make you question your wins. It's so crazy how it works. The better you do, the scarier you get. It's weird. So it keeps you from just sitting on a win all day. Trailing drawdown is the second worst rule. So if you are paying to beat the system, you want to pay for something with the minimum number of trading days to pass. And you also want to pay for something that you can actually just not have to do trailing drawdown. Trailing drawdown is a scheme. It's a psychological nightmare. It's designed to exploit your emotions. Okay. And there's number 6, which is just kind of like part of the normal thing, is they punish you for holding on to a win too long. Actually, number 6 will do something different. They exploit your lack of understanding of volatility. I'll put this right here. Volatility is what causes you to chop. You bet too big, and volatility will get you in both places. But volatility, as well as giving you more than you need. So they're exploiting the fact that you don't know that it's more than you need. You don't know that. They're exploiting the fact that you don't understand volatility, that markets chop around. The trailing drawdown will kill you on volatility, and so will betting too big. Combination with volatility. Time and market, that you don't understand that the odds are against you. Just like a casino. Each one of these rules are designed to exploit something just like a casino. So trailing drawdown exploits the fact that you close too early. They limit your win. Number 6, they limit your win with the consistency rule. This is attack number 2 on your winning. If you win too big on accident, so it's like they sat there and thought of every scenario. What happens if the market blasts up and somebody blows up? Well, they blow up. Okay. What happens if somebody blasts up and they win? Aha, let's do consistency roll. And so what happens when you pass your consistency roll, right? Say that like Tradeify, for example, has a $9,000 profit target at 20% consistency, right? If any of my trades go over $1,800, which is 1/5 of this, then it makes me have a bigger target. If I had a trade that was $5,000 and my profit target was $9,000, but yet I made $5,000, I now must make $25,000 because that's what will allow consistency to me. We all understand consistency rules, right? A consistency rule makes you trade longer if you win too big as a punishment. So the consistency rule basically says, well, trailing drawdown says if you hold too long, we'll bust you. If you're betting too big, volatility will bust you. If you win too big and don't close early, we'll bust you. If you win too big on a news event, we'll make you stay in the market longer. Aha, cover our base. So consistency rule is a sneaky way for them to put more time and market in your place. And again, time and market, you must understand if you're watching this stream, is the strongest rule. It ultimately is not, it's not a trick rule of trailing drawdown or emotions or anything. It's the simple fact that the market's going to beat you just because you're bad at trading. Doesn't matter what kind of rules they make. The longer they keep you in the market, most all of you are just bad at trading. And you're ultimately going to get beaten by the market. So the consistency rules force you back into more time in market. Does that make sense? Everything kind of draws you back to you must trade longer. Bigger, oh, you bust your consistency rule. Okay, you got to trade, $10,000 more. And the only way and then you trailing drawdown, oh, you got busted. You got to start over. But then you're back in the market. And the longer you're in the market, the more the market's going to will you down. And you're going to perform bad at all. The more they stretch the time between now and when you get paid out, chances are time and market's going to get you. And the longer you're in the market, the last thing is that they're going to bet on the market just kind of sweeping everybody half the time, especially in volatile markets. A lot of them will have their sales during a volatile market because they want you to buy more accounts because people are going to bust all the time. Trump tweets something and the market goes up 10%. Half of the people out there busted their accounts just being on the wrong side. The other half of the people busted their accounts jumping into a 10% move, being idiots, and then taking drawdown on the way up. So maybe 25% rode it up, right, on accident. The market moved up 8%. Congratulations, you guys all won money. But no, you got to stay in the market longer because you busted your consistency rule. Now a trader funding program is covered on all bases. You can't win too big. You can't lose too big. You can't lose a little bit with a big gain or trailing drawdown will get you. And you must be consistent because if not, we'll make you stay in the casino longer. If you were winning at blackjack and you won $1 million pot, they say, we're not going to give it to you unless you win 10 more hands. Well, then there's the game, right? So the game is only designed to reward one kind of trader. A trader with a high win rates. The only people that profit from trader funding programs are people that have a high win rate. If you are a high risk to reward trader with a low win rate, you will never win trader funding programs because the volatility will ultimately get you. You can't trade 4 and 5-to-1 trades, especially with trailing drawdown, because to move, markets don't just move up 5 and move down 1. Markets are going to move up 2 and down 2 and up 2 and down 2. Volatility will get you if you need a big win to overcome profit targets. The only way that you will make money in a trader funding program is to take base hits with a high win rate. That's it. You need to avoid all the rules that I showed you that they used to squeeze you. You need to skirt all of them. So let me walk you through how I do it. Now, again, I showed you guys at the beginning of the stream. You guys know, if y'all watch the stream, my win rate is 75%, give or take. And that's in a crazy bear market. Most of it is due to one fact and one fact only. Those of you that watch the stream, tell me with what the rules I just told you so far, what is the one thing that you observe that I do differently than most traders? Which prop firms do we recommend? Take Profit, Trader, and Tradeify are the two best right now that I'd recommend. And we have codes for those. It's Rocket Scooter if you go there. You get huge discounts. Can I give you a systematic guide on the topics you should learn for better analysis of markets? Yeah, I'm going to teach you guys this in just a little bit. Risk management, market avoidance. Market avoidance, K-Spec said. David, market avoidance. Scooby says spreading risk. Market avoidance, you guys are nailing it. I spend most of my time avoiding the market, don't I? That really is the trick. Attack only when your setups make sense. When you have the understanding that the more you're in the market, even if you're longing a position, I'm going to wait all day, see if my trade plays out. Well, every moment you're in the market is a moment closer to Trump's next tweet, right? You kind of want to observe this is not how you're going to make the money. You need to observe this as the lightning striking is bad in both angles. Remember the other day I was holding a position. I was long and the market bumped up very quick and immediately I'm over there, close. It doesn't matter what happens. Any event where the market moves quick, I went out of the way. That's how I'm different. Oh, I went up the market went up 1.5%, like on a blip. Let me go read the news and see if I want to hold this for the rest of the day. Never. If the market goes against me or in the direction on a news event, I'm just going to get out of the way as quick as possible. I don't want to trade markets that do this. I don't make my money that way. I make my money with consistent base hits with a high win rate. The market can jump all over the place. It can pop up and then immediately sell off. I'm scared of single event-based news. If I'm in a trade, y'all noticed the other day that happened. When I'm in a trade, the market burps in my favor, I close out. It burps out of my favor, I close out. I don't want to be in the market when a news event moves it the other way. It's not how I make money. I don't want to play volatility. So number one is I avoid the market. I avoid trying to get windfall gains. I'll just close out and walk away. I'll let the market do its thing. I'm not holding on to a trade that long. Most of my trades, I'm in and out probably in 5 to 10 minutes a time. I scalp, day trade scalping high probability liquidity pockets. And that's really my edge. It's 90% chance under ideal conditions. So a couple of things I do is I avoid volatile markets as much as I can. Or I adjust my position for volatility. So an example, I avoid volatility with high risk. So in general, I don't have Thinkorswim installed here on my laptop. I bring out a VIX chart. But we have two indicators we teach at Rocket Scooter in our boot camp. We call it the VIX triple B. It has to do with the VIX futures and VVIX. VVIX is an indicator of how volatile the VIX is. If VVIX is greater than 100, or VIX is below this key triple B level, it has to do with how much contango is built into each contract. This is an easy number that we give you once a month. If you want to start winning in trader funding programs, immediately. And again, I'll teach you guys this number on the stream once I get my computer up and running. If you wait for VIX futures to be in a place of contango, where you're below the contango midpoint, what this is a number in VIX futures that when one contract is expiring and you roll into a new contract, they're usually priced differently. This is when the new contract takes off and the old contract expires. The midpoint between the two contracts around that Wednesday rollover of VIX futures is that triple B level. If you're just trading below that, which means you underprice volatility and the market's accepted that, that's what we call the ideal volatility environment. It's not how high the VIX is, it's how high the VIX is relative to the previous contract. That's ideal. It's one number once a month and it never changes until the next month. Ideal. If you want to start winning trader funding programs, wait for the month where this is there. You've eliminated the idea that the market has unusual volatility or is more sensitive to catalysts and events. Case in point, when VIX is below that key level and the Fed raises rates, the market might stay, S&P might stay in a 50-point range. NASDAQ might move a couple hundred points or less. If VIX is above that number and we underprice volatility and it's accepting that and moving higher against the previous contract, then the S&P might move 300 points, big moves, crash moves, more sensitive to catalysts, events. So you don't want the market to have unusual relative volatility, and you don't want the volatility to have unusual relative volatility, which is the VIX itself, the volatility of the VIX, which is volatility squared. It's ideal to have both of these conditions there so that way the market chops less. This is an environment where both of these things are not true. The market's chopping up and down. I think we're below triple B now, but it wasn't like this before. Markets moving up and down. You know, NASDAQ was having 100-point candles, wasn't it, in every minute? So that's kind of what you see in the opposite of this. Ideal candles, VIX is going to move up 10 points a minute. S&P is going to move up 2 points a minute. Okay? So number one, if you want to avoid the volatility game, is when the market's, if you avoid the market until your volatility conditions line up, and come to the stream on Monday, I will show you how to calculate both these numbers or find both of these numbers. That way, the market's not chopping against you and therefore trailing drawdown, which is the enemy to volatility or enemy to you because of volatility, doesn't get you either. And when this environment's ideal, the market kind of ebbs and flows a little better with no volatility. Okay. So it's not how high the VIX is, it's how sensitive the VIX is to news and the change of the VIX itself. Sensitive to news and change of the VIX. These two numbers will tell you if the market going to be nice and robust. Fed cuts rates in the middle of this being ideal. You're like, why didn't the market rally 3%? The market just went up and came right back down. Because the market is very much pricing. This is the we priced it in already indicator. The market's already priced it in. There's not going to be an upset when the news comes out. It's already anticipated. And therefore, there's not going to be a big change. These indicators will tell you the market's already priced in. Ideal situation is you want the VIX to be lining up where you are. Number two is you want to account for volatility. If these things don't line up, account for volatility if you need to. We teach you guys in our boot camp is that the more volatile the market is. Now, volatility is the lack of liquidity. Liquidity is where buyers and sellers in the closest proximity. If I were to buy a house at 100K, here's an example. There's a bunch of houses in the neighborhood that are worth 200K. And somehow I found a house that's worth 100K and it needs some work. Well, because of the comps around me at 200K and the work is 50K, and I look and see, these houses are flipping very quickly, then I can make a profit on this, put 50K in, spend 100, make 50K to flip it, and then I can sell it quick. All those pieces are there for this to be a liquid transaction. I buy and I sell, and I can move that house pretty quick. But if this was like the same thing in the middle of the desert, in the middle of nowhere, and people aren't necessarily buying houses that quick, this might not be of value, because even though I can make 50K, if it took me 10 years to sell that house, that 50K actually lost money because it could have been invested elsewhere. The 100K I put into the house could have put in something else that could have made money. So time is a problem in this market. The longer it takes to flip something, the less liquid it is. So in the stock market sense, liquidity is how far away your buyers and sellers are from each other. Your buyers are here, your sellers are there. Well, if the market is less liquid, your buyers and sellers are there or there. Okay, they're spread out a little further in price or in time. If I were to look at a transaction, and let's just say there's a price graph, and this is the low that people are buying at in the high, okay? And people just bought at the low and bought at the high and bought at the low and bought at the high. But what if each one of these pivots is like second 1, second 2, second 3, second 4, and then all of a sudden it takes longer to find a seller and longer to find a buyer at the same price? When it takes longer for that trade to take place, the market is less liquid, because of the house flipping analogy. It's less liquid because it takes more time. But it's also, when time is the same, less liquid when the price discrepancy is higher. So volatility comes in two flavors, price and time, and they're both part of the VIX equation. In general, the longer it takes for buyers and sellers to find each other at the set price discrepancy is a higher volatility or less liquidity. Or at the same time interval, when you reduce the time, the farther apart they are, the higher the price discrepancy per time is also less liquid. So markets are less liquid. Typically on the price discrepancy portion, the market has a bigger space between buyers and sellers. So the market chops around more. You perceive it as what we call volatility, but volatility is the absence of liquidity in the price discrepancy portion at a fixed time. And so the volatility equation does incorporate time into its equation, which is why VIX decays over time. But in either case, you're going to perceive volatility as a trader, not through the time decay. The time decay is slower on VIX than the actual choppiness of the market. The bigger the V's in the S&P or the NASDAQ, the choppier it is, the higher the volatility. So in a general rule, the higher the volatility that you're going to have, you're going to bet smaller. Example is, if this is my pivot to long off of, 88% of days at the Rocket Scooter platform will close in between these green lines. This is one of our big winning trades here. I always buy this green line at the bottom every single time. Call it every single time, actually. I'm giving you 5 setups today there every single time. I always long here. 4% of days close above and 88% of days close in between. So 92% of days will bounce off of this green line, at least for a scalp. I never not take it. Okay, but if the market is volatile, i.e. the first rule I told you, then there's a way you have to enter it. So you have to know that unless you're avoiding the market purely avoiding the volatility, if you hit a pivot when it's ideal, normally you're going to get close to the pivot and rally, or at maximum, you'll just touch it very quick and go. This is ideal volatility, okay? The market understands there's a very sharp set of buyers at a liquidity pocket or liquidity point we find. When the market is not liquid, you're not going to have a cluster of buyers here. And the non-ideal world, what you're going to see is that the market's going to like chop around and maybe even overshoot your pivot before you go, or even miss it by a long shot, or even break it to your stop loss and then work its way back and go. Non-ideal volatility, the market lacks the buffering to the selling, or it lacks a big thick set of buyers to keep the market from just chopping around more. So when the market is non-ideal, or these conditions are not true, higher volatility, you need to spread your bet out around your pivot. The rule I have is when both of these rules are violated, or one of these rules are violated, then if the market is falling to a pivot I take every single time, I'm going to take an example. If I chose, I'm going to trade 5 contracts today. I'm going to long one right before the pivot. I'm going to let one overshoot the pivot. I'm going to long 2 more. And I'm going to let the market fall to my stop loss and then long the other 2. Right near where my stop would be on my original pivot. So an example is on S&P, my stop is determined by 2 factors. Number 1, it's the maximum of these 2 numbers. For ES, it's 10, and for NASDAQ, it's 40. Or the largest 1-minute candle in the last hour will tell me about how much the market is going to overshoot my pivot. It's the best rule of thumb you'll ever do. Write it down. How much can you overshoot a pivot? What's the volatility like? Well, if the NASDAQ is having 100-point candles every minute in the last hour, then you can assume you're going to overshoot 100 points. If the S&P normally is 10 points and NASDAQ is 40, if the overshoot is 25 or 120, then this is my overshoot or my stop. So my stop will be 120 points patterned right below the actual pivot. So I'll take my profit. Imagine this was NASDAQ. I'll take my trade and I'll split it up. 1 here, 2 60 points lower, 2 120 points lower. And now I got my 5 contracts at a cost basis here. This is called cost basis management. I get my cost basis actually below the pivot so that when it chops around, I'm betting that it does reverse. My cost basis is much lower. Whenever the market is ideal, though, I'll throw all my contracts right here at the pivot. And my stop loss is usually tighter. Once I get my cost basis in here, then I have my normal stop of 40 below my last entry. Or 10 on the S&P. But I give myself the amount of room to step my position in bigger. Now, in a regular account, now this is a cool trick too. In a regular account, I could do 1 contract, 2 contracts, and 2 contracts. But in Tradeify, when I have 5 accounts, it's 1 account here, 2 accounts here, and 2 accounts here. That trick will allow me to continue to go as 4 of the accounts almost always make money on a good, strong pivot, and maybe 1 will take a loss or even 1 might bust. If you see my Twitter in this volatile environment, you will see all of my trades reflecting exactly that. Every P&L I post is like this. It's like this. They're never the same. Every one of my 5 accounts is always staged like that. Always staged like this. Always staged like this. Do you see what I'm doing, guys? I'm taking more risk in the first account than in the last account. You'll never not see that. This is the trick to beating trader funding programs. You are practically DCAing, because a lot of them say you can't DCA. Well, fuck their rule. Spread your accounts out. If you trade all 20 accounts and you bought here and then bought again and bought here, a lot of these firms like ETF and others will cancel your account. You're not allowed to dollar cost average in. Well, fuck their rules. Spread your accounts out. It's exactly like scaling in your account, but instead of scaling in the contract, you're scaling with other accounts. So at most these days, I've been lucky, all my accounts have been making money, but even if I did bust an account, which happens fairly often, I say fairly often, but like, once a week or something, volatility might get me on one of the accounts and I'll start over, but I never bust for the accounts. I take the bulk of my risk right near my stop loss. Look, 1 account took a loss, 4 accounts took a win. They're never the same. And my accounts have been steadily growing. And I've taken 6 payouts, and my accounts have just been growing. I never put all my eggs in one basket, and that's how I survive. Lots of pictures of crawfish and IDOC here. But yeah, you will never see me trade my accounts this way. Now, if you have 20 Apex accounts, do the same thing, except instead of trading 20, trade everything in groups of 5 if you can. Of your 20 Apex accounts, make 5 groups of 4 contracts so that you can trade 1 of your accounts, 1 group of 4, then 2 groups of 4, then 2 groups of 4, and there's your 20. Aha. Now what you're doing is actually dollar cost averaging in and adding that martingale feature to your low risk strategy, in that you bought 20 accounts. And instead of putting all your risk at your pivot when markets have high volatility, spread your risk around your pivot, right near your stop. And therefore, as the market chops around, you could just get lucky in the bottom two and maybe barely. And your bottom one is always, your top one is always designed with the contract size, that each one of these, what's the size of the contract? Well, each one of these is going to take a different amount of drawdown. Accounts 1, accounts 2 and 3, accounts 4 and 5. Each one of these will have a different position size to account for the drawdown. This one could fall 80 points. I might only do one contract in that one. And this one can fall 40 points. Let me do 2 contracts in those 2. And this one can fall 10. Let me do 3 contracts in those 2. So I'm doing a combination of both. I'm putting smaller position size in fewer accounts farther away from the pivot, and then adding a bigger size to more accounts as I fall. So overall, I'm dollar cost averaging while spreading my account risk out. The one that's going to possibly take the bigger drawdown is always the one with a couple micros or one contract. I'm literally spreading my risk out and accounting for the volatility. Volatility is what gets you. Number 2, trick number 2, and this is going to be something that you guys take my word for it. Number 2. So number 1 is you're going to account for volatility or avoid volatile markets if you can. If you wait for my ideal VIX, you're going to start winning trader funding programs. Wait for the market to not be sensitive to the news. You're going to realize those nice, clean, easy markets, and wait for that time of the month and then hit them all. Say you pass your 20 Apex accounts and you're ready to go fund, and don't just jump in the market the next day. Sit on your hands, even if it takes a couple weeks for those volatility conditions to line up. But come Monday on the stream, when I have Thinkorswim on my computer, I'll show you guys where to get all the data. I don't have VIX futures here, or Box Scooter. Okay. All right. Spreading your risk, accounting for volatility. Number 2, buy your freedoms, pay for freedoms. So accounting for volatility. Know your opportunity cost for the things that cost money. Pay more money to the firms. Here's a rule of thumb with these prop firms, is that usually the cheaper they are, the crazier the rules are. Hey, Apex, 90% off, $10 to the account. Yeah, but they have trailing drawdown. Ugh. ETF, $20 an account, 80% off. Ugh. But they have minimum day consistency rule and you can't DCA. That sucks. You have to stay in the market for 10 days, or whatever it is, or how many days they make you stay in the market. When it's cheaper, the rules are harder. When it's more expensive, the rules are easier. Pay firms more. You're going to try to pay for less time in market. Okay. You're going to pay more if it gives you reduced cost, or more expensive to get you fewer days in the market. I promise. It doesn't matter if Apex is a 10th of the cost and you have to stay in the market 10 times as long, not Apex, but any firm is a 10th of the cost. You have to stay in the market 10 times as long. Pay more money to stay in the market as less as possible. Time in market less. Number 2, pay your way out of trailing drawdown. Buy end of the day drawdown only. Only ever for the rest of your life will you do end of the day drawdown accounts. Top 1 futures are good. I haven't used them yet, but I'm hearing good things about them. We do have a code with these guys now. It's Rocket Scooter, so you can use Top 1. So end of the day only. As we talked about earlier, the trailing drawdown exploits the fact that you don't understand volatility and that you get punished on your wins for holding too long and makes you close too early. All those psychological barriers, get rid of them. End of the day drawdown only makes your account a static throughout the day, and the drawdown only resets once a day. So get rid of trailing drawdown altogether and get end of the day only if you can. It costs a lot more, but it's because the failure rate of trailing drawdown is so high. You get punished when you're winning. That's the stupid part. So buy your way out of that rule. Pay the firm more to get out of that. And the last one, so you have time and market reduction, end of the day only, and last ways, skip the eval if you can. Remember, time and market is what kills you. Well, the fact that you have an eval stage, you got to pass, and a funded stage, and you got to hit consistency. The fact that they make you pause for 10 days is adding more time and market. So again, pay to skip the eval. The straight to funded world is the way to go. I have made infinitely more money. Well, not infinitely, but I've made a whole lot more money paying $500 per account with Tradeify than I ever did paying $20 plus $100 activation fee with Apex at $20 an account. I have made more money with my $500 investment because the rules are easier. I skip the eval, reduce my time in market, and it's end of the day drawdown. I pay more upfront to remove the barriers of my failure from me. Don't spend less money for harder rules. The rules are a lot harder than you think. That's what people don't understand. The rules don't, one extra day in the market should be half the cost. Okay. An eval of, you have 5 days to pass an eval or something, should be a fifth of the cost. So if it's 5 times more expensive to skip a 5-day eval process, pay 5 times as much. Think of it like that. Every day is double the cost. If you have, if you have to spend 2 days to pass an eval, and then you can pay double the cost to not, then pay double the cost. As your cost basis of what you want to spend on these accounts, go straight to funded if you can. And for some reason, and I know Brett's a smart guy, but Tradeify somehow is the best of all worlds. They have the cheapest straight to funded, skip the eval, end of the day only I've ever seen. It is almost too good to be true. The time in market is nuts. I mean, it's 10 days between payout cycles, but you only need to hit profit target and you can flip the accounts. They don't make you trade 10 days. ETF, however, makes you trade X amount of days. Each day has to be a minimum amount. Tradeify doesn't. It just needs to count as a trading day. So for some reason, their risk model is very, 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 very nice on the straight to fundeds. Take profit, also very good. Once you get over the buffer, right? So just remember in general, you want to make sure that you can buy your freedoms, buy your way out of the rules that keep you in the market longer, and buy your way out of trailing drawdown if you can. It's 10 days of minimum trading. However, they don't have a minimum number of that trade. That's the best part. Anything counts as a winning day. You just need to win. You need anything. You don't need to make a certain amount. 100K costs $450 on Tradeify, yeah. So remember, don't just say, these accounts are cheaper. It's a risk model. Every prop firm has the same risk. If one of them's cheaper, it's certainly harder to get there. The risk is the same for the in minus out model. Something that's less cheap is going to be less hard. Something that's very expensive is going to be not hard at all. It's all the same. For you, it's all the same. But what you don't understand is the cheaper ones are not scaling linearly as hard. This might be 100x harder, then this is 10x harder. This is 1x harder. For something that's $100 versus $300 versus $500. The scale of how much you pay to easiness is not a straight line. You don't know that because you're scared of the high dollar. The more that you spend, the easier it goes this way. I have found through my studying of all the different firms that the easiness of the rules when compared side by side is exponentially better for just a few $100s a month. It's ridiculous how much people congest. I know the sales. I know what you guys buy. It's crazy. It's so weird how everyone congests up here for a 100x failure rate. Then people spend a little bit more for like a massive amount of improvement. So remember, you want to make sure you reduce your time in market and get rid of trailing drawdown and skip an eval if you can. All three of those is a plus. Tradeify is why I with them is because they have all three. And that really just makes, okay, so I'm paying $500 for the funded process. So Apex is $100 if you pass, 20 for the eval when it's 90% off, and then 100 to activate, right? So it already costs you 120 and you still got trailing drawdown. Tradeify, it cost me what, $500, I think, something like that after the code, and I'm already there. If I fail 5 times in Apex, it was cheaper to go with Tradeify. And trust me, I will fail 5 times with Apex with trading drawdown. I might fail 20 times with Apex before I pass and get funded. So the weird thing is that the cost is like so rewarding on the more expensive accounts. Don't let the price fool you. They kind of sticker shock you, but on a win rate basis, if you were to look, and say, don't take my word for it, spend a month in one and a month in the other and compare how much you actually spent. I'm sure people spend a lot more in Apex than they do in like a Tradeify. ETF has an end of the day drawdown as well. But yeah, there's a lot of people that have them. 20% consistency rule, I ignore it. I don't even care about it. Rule number 3, if you have a high win rate and you win with base hits, consistency doesn't matter to you. It doesn't matter to me. Time and market is not a problem for me. I stay in the market longer because I avoid the market while I'm in it and only strike when it matters. Example is I've got a bunch of pivots here, and I'm going to show you some of my pivots. The Rocket Scooter platform has them, but I have some trades that I take. This, and again, our platform will show you. One of them I talked about earlier is I trade off of this band. About 92% of trades off of the lower band will give me a sizable bounce, so at least give me a 1-to-1 trade. I trade off of monthly hedge pressure, which is a gamma exposure level every single time. I trade off of liquidity pockets every single time. This was my bread and butter last couple of days. I think I made like 20K in the last couple of days, just scalping 10-point base hits. Short markets, I have some really solid setups here too. Each one of these, if you guys know our platform, this is a 90% bounce under ideal conditions, 80% bounce, 90% bounce, 80% bounce, and this is 92. This is 90. Under bearish conditions, this is 90. And this is 96. Under ideal conditions. Just these alone are enough to give me a 1-to-1 trade with those probabilities in ideal conditions, which means, well, and we teach you that in our boot camp, or I'll teach you that on the stream. Ideal conditions require no irrational markets and such. I have a bunch of indicators on my platform. These lights right here. When these lights are green, those odds are 80 and 90%. When any of these lights are red, those odds drop to about 60%, give or take. We say 60. Still greater than the house edge. Right? We still have an edge over the house. However, I'm still looking for base hits. I might lose more often, which means spreading my risk is helping me at least survive in 4 if I lose in 1, but that's okay. Spreading your risk accounts for irrationality and volatility. So our strongest bull setups are monthly hedge pressure, which is monthly gamma exposure, weekly gamma exposure, and liquidity pockets. This is where liquid markets are. And liquid markets tend to not crash. They tend to find support. And that's kind of one of my best setups I have here. So what I'm doing is I'm taking base hits as much as I can, and I'm trading straight to funded accounts and spreading my risk out. If I have a nice liquidity pocket under ideal conditions, liquidity pocket, market falls to bear zone top, from here to here is a 90% trade. Usually, if it's not volatile, I'll hit it with all of my accounts. Like I'll just throw 2 contracts in all of my, it's the only time I'll put all my accounts together. If the market is volatile though, and say the distance of this is 10 points on the S&P, but I've noticed the 1-minute candles were 20 points, then I possibly have 10 points of drawdown. So I'll put 2 of my accounts at the border, the other 3 of the accounts down here. 2 of the accounts with 1, 3 of the accounts with 2. And I set my stop loss for all of it 10 points below this guy. And trade it right back to the pocket. 2 of them might take a big drawdown. 2 of them might blow up. 3 of them might take a small loss. But 90% of them, under ideal conditions, don't lose. So the idea is I'm spreading out my risk when volatile. I'm spreading out my contract size to account for the volatility. And I'm only trading high probability setups. And I'm in and I'm out. And I do a lot of base hits. I do like 1-to-1 and 1.5-1 trades. I have high win. High win rate is helpful because A, it makes me wait for the setup I want. Market's ebbing along. I'm not chasing this green. I'm not chasing this red. I've got 2 pivots to play with. I'm waiting, and then it hits my pivot. Then I make the decision there, make my second decision there, stop there, whatever, and then I make the trade, and then I get out. I don't chase a trend. I always am reversing up a high probability pivot. And I'm in and out as quick as I can, which means I'm avoiding Trump tweets as much as possible. I'm in the trade, out of the trade. The more volatile the market is, the faster it is I'll get my trades. Some of my trades the last couple of days only lasted 2 minutes. And I made, $1,000 in 2 minutes kind of thing. Because the volatility gives me that travel that I need. And other days, I might be in the market longer when it's not volatile. But the idea is to be in and out as quick as possible such that I don't get blown on all 5 of my accounts on a random tweet that comes my way. I seem to be lucky to avoid this all the time. I never seem to be, oh, guys, I busted all my accounts because of a Trump tweet. You never hear me say that because I don't have all my accounts exposed to the market at any given time unless it's an ideal market with a 90% setup and I'm in that market for 10 or 20 minutes and I'm out. the chance of Trump tweeting in those 10 or 20 minutes, it's low. It's a low probability. We've got all day to say something, and the chance that it overlaps my particular trade is not it. I'm not always trying to guess the direction of the market. I'm scalping a liquidity to liquidity move and repeating that over and over and over and over again. I'm not sitting in a flat market all day taking drawdown and ending up at the end of the day. My trades still have me in the trade for 2 or 3 hours at a time because I've learned to avoid that. And my day trading, even not in a prop firm, reflects the same type of mentality. My real account is the same thing. I'm in and out of scalps as long as I can. My trades are never 3 hours long. Base hits or consistency. And even if I bust my consistency and get lucky, I just continue to stay the course. One of my accounts of Tradeify made $5,000 on a $9,000 profit target. So I need to make $25,000 to get paid out, which is a journey for that one account. But you know what I'm doing? I have to continue to make $5,000 days. It's the end of the day drawdown. I've got buffer in that account. So I'm pretty good. I have enough buffer in that account that I don't care anymore, because now I just need to have $5,000 days. And so that means I just need to bet bigger or just slowly get my way there with regular sized trades. So you have two courses of action: is you can continue to stay the course to make your other trades the same as your big sized one, or you just keep in the market longer and count on your base hits carrying you. Got plenty of buffer, by the way, to avoid blowing up the account on losing days because you're way far ahead anyways. 5,000 is way up on that account, right? Do I add to a winner so it doesn't get to your lower ones? I never add to a winner. This is another thing I don't do. I never add to a trade that's winning. Because in trading is a pyramid scheme that rewards the first person in a trade. That's it. You're in the trade and more people come after you. If you were lucky to be in the trade first and you start getting the win, why would you jump in at the back of the line with the idiots? You're now the idiot. That's the way I see it. I reserve my capital to average into a trade to lower a cost basis to turn it into a win. I never add when a trade is green. Never. Because now I'm the fool. The greater fool theory states that when you buy something at a price, you need somebody who's more foolish than you to pay more for it so that you can make a profit. So the greater fool theory is stating that you only make money in certain investments if there's a greater fool than you. And ultimately, you run out of fools to fool. And ultimately, something's too high for anybody to buy. If you jump in the middle or towards the end of a trade, you might actually be the fool. That's the risk I take. So I don't really add to a winner. I might take a second trade in the same direction. I perceive a winner as different than I pick the direction right. If I have a liquidity pocket from here to here, and then I long from there to there and close out, and the market continues to rally and then hits another liquidity pocket and I long from here to there, that's not adding to a win. That's taking a whole separate trade for a separate reason. So in a normal situation, one person might take the win here, market keeps going, and then add to the win there. This part is not really charted or predictable. This part is. So I'm not adding to a winner from here to here. I'm taking it as a separate trade. I'm the first person in this one. I'm the first person in that one. So I don't want to add money towards the middle or end of a run because I could end up being the foolish one at the end of the line. You want to try to be first as much as you can, which is why in my style of having an edge, I'm looking for the place where I think it'll pivot or will pivot 60 to 90% of the time. And I want to be the first person in the trade. You might notice all my trades share that in common. I'm the first person in the trade. I'm never, oh, it's moving, let me get in on this. It's very rare you'll see me do that. If the market moves like this, it's very rare you'll say, well, guys, I missed that move. Oh, well. And y'all see me do that on stream a lot, right? Oh, well, I missed that move, right? Y'all see that all the time. I'm usually sitting out on a big run. You get one or two tourists come in the trade and they're like, why is this guy not trading? Well, Matt missed his move. I don't see that and feel the need to get in on it. I don't see that and say I'm missing out on something. I don't miss out on anything. I take a trip to the bank every single day in trading. I live the dream life. There's nothing I'm doing. I'm not missing out on a single thing, missing out on one day's move. If I didn't get the entry at the beginning, it's not worth it to me to chase in the middle. Getting caught with your pants. You don't want to get caught with your pants down. Exactly. You don't want to be the last person in a move. Any one of these things, especially like Friday or Wednesday, if the move stimulated, you decided, oh, finally, let me get on that. You took a loss. This day, especially volatile days, punish you the most on that. Ooh, the market popped. Ooh, let me long here. Shit, I took a loss. Market popped. Ooh, let me long there. Crap, I took a loss. Market dipped. Let me short that. Crap, I took a loss. Right? The market very much punishes people for chasing more often than it rewards them. And don't be conditioned that the first time you jumped in on a big move like the Trump 10% move day and you made money is that you should jump in and ride waves. Okay? Very rare does that happen. Jumping into a trend usually drowns the swimmer. Doing this for 15 years, I know. You can count how many times on here that a 10% move, because the market was just volatile, I'm just going to draw some, randomly punished you. 10-point moves. If I longed at each one of these arrows, I took some heat before I won. Long there, took some heat. Long there, took some heat. Like if you require the market to break out before you jump in, days like this would have killed every single one of your trades, right? Discipline in trading is extremely important to wait for your setup. Typically, I want to be the first person into a trade as much as I can. I'm going to wait for my pivots and strike because I'm requiring the high probability to carry me, and I'm not needing the trend to carry me. I need the thousands of base hits to carry me. The fact that I can win most of them to carry me. If you only have one funded account, do you calculate the cost average the same since it'll only be one account? With one funded account, you need to account both ways. So instead of taking like spreading your account through multiple accounts, Kristen, what you'll do is trade much smaller in just one account than you normally would if you had 5. So the fewer the accounts, then you just trade smaller. If I had 5 accounts and I do 1 mini and then 2 mini in 2 of them and then 3 minis in the other 2, instead I might do 1 micro, then 5 micros, then 2 minis or something like that. Like scale your risk bigger, like in your 3 entries that way. Start out small, 2 or 3 micros, then hit it harder with 5 micros, and hit it harder with a mini or 2 that way. So that way you're spreading your risk out exponentially. The idea is exponential. You're not buying 1 and then 1 and then 1 more. You're buying like 1 and then 2 more and then 4 more right at the edge. You really want to get your cost basis lower. I only add with the intent on lowering my cost basis, which reduces my risk. Anytime you add to a winning trade, you're actually increasing your risk. So therefore, you're increasing your possible loss by your bad entry. When I add money, I'm adding to where the position seems like it's red, but it's because I'm deciding to lower my cost basis. And that cost basis management trick, or what they call DCAing in the prop firm world, is very, very useful. That's why they tell you not to do it. The rule of thumb in the prop firm world is there's a rule that says don't do it. It's because it actually helps you win. They don't want you doing stuff that helps you win. Don't count cards in Vegas. It's because it helps you win. So you want to try to be first in the trade as much as you can and scale your risk exponentially. So if your total max that you're going to use is like 2 minis, right? Then put in 2 micros, okay, at your first entry, right? And then put in maybe 4 micros at your second entry, and then 16 or 14 micros at your last entry. Like your risk is like, and then that's your 14 go right near your stop. Your biggest bite goes near your stop. So see, each entry isn't like 1, 2, and 3. It's like 1, 4, 1, 2, and 4, or 2 and then 4 and then 8. It's bigger. It's exponentially bigger. Because what you really want to do is get your cost basis as close as you can to your stop as much as possible, but spreading it out. Like, so if I had 4 minis to play with, I might start with 5 micros and then 10 micros and then the other 25 micros or 2.5 minis here. To really just take a small bite and then a medium bite and then a smack the bite in case the market does dip right to your stop. Then you pile into your biggest part of your position. This little trick right here is why I win most of my trades. The position management of just taking small bites. Now, you get smaller wins if your first entry was a winner, but it doesn't matter. What you really want to do is save as much money as you can in your pocket so that you use that money to either dig yourself out of a hole by lowering your cost base, just making it easier to wiggle out of a loss. But you're not putting big risk far away from your stop. Always build around a position, especially in volatile markets like this. What percentage of max drawdown do you use for 1R? So the max drawdown, it depends on what stage of the game I'm in. When it comes to like eval accounts, I'll blow up the accounts in a single trade. I don't care. If they're 90% off, I don't care burning through 100 Apex accounts at $10, $20 a piece to get my 20 funded that day. If it's with something more substantial and more expensive, like a Tradeify account that costs me money, I'm usually willing to trade and risk whatever my consistency is. This is the rule of thumb I use for accounts I don't care to blow up quickly. Is that if the strategy with Apex is to just blow up quick when they're cheap and then brute force your way to the end, it's super cheap to do that. With the Tradeify, I've got 5 accounts. I have $9,000 profit target with a 20% drawdown, 20% consistency, and a 10-day account minimum per time and market per payout, which means my trades need to be between $1,800 and $900 sweet spot. $900 times 10 will get me to $9,000. $900 is my, if that is my profit over 10 days, then my consistency is great. I had 10% consistency, which is good. $1,800 will get me there, and then flip the account 5 more days, and I'm fine. And so I'm trying to target is somewhere in between here and here. With Tradeify, the drawdown is $37.50, I think, on the end of the day drawdown. So if I'm using my consistency and time and market to actually tell me the size of the trade I'm going to try to do. And this, by far, if I'm aiming for like 2,000 a day, this roughly gives me two losing days and I bust at max position. 2 of this scale, 4 on this scale. So I roughly get 2 to 4 total risk of max drawdown for 1 hour. Does that make sense, IR? And that's totally acceptable with these. So you tell yourself, if I blow up every 2 to 4 days, can I afford $500 to reset the account every 2 to 4 days? And the answer is, oh, hell yeah, I can. So the final question is you try to aim for your max and min profit for your base hits. Based on your time and market will set your minimum usually, and your consistency will set your max. And then you see about how many days to where you draw down and bust. And then you say, can I afford the cost of the account every 2 to 4 days? And if that's the case, then that's the case. If that's not the case, then you just lower the amount at which you're going to take per day, as long as it meets both criteria, and then that's your budget for the week. If you got $5,000 of expendable income you're going to spend every month on prop firms, you're going to do the same formula to figure out your maximum position and meet consistency and time and market rules for the number of days that you can lose to meet your drawdown, and then that's your budget for the month. If you don't exceed your budget, you're going to have a fun time doing this. If you exceed your budget, then you're probably going to be in a bad spot. Do I feel that the 50K accounts can be traded properly based on proper risk management? 50K what? Which brand? Yeah, so Patty, you're 100% right. If your first entry at small risk takes off as a winner, your mind says, but I could have made more. And that is the one thing that I tell everybody to have to get over. Your mind says, I could have made more. You know what my money said? My mind says, hey, I made something. So the mentality should be a win is a win. And that's what you should teach yourself. And everyone teach yourself this. A win is a win. And write that down if you want to take notes. Matt says a win is a win. If you feel like you could have made more, this is where, and I'm going to blow your minds with the consistency. See, everybody always says one half of that sentence. Okay, ready? I'm going to type it. So you get this right. Patty, I love that you spoke up. She's a great example of what I want to teach. I could have made more. And people type, I could have made more, but they don't type this. Tell me the difference between the 2 sentences. Oh, yeah, South Cat Dad, yeah. I could have made more, and I could have made more ... have 2 different meanings. I could have lost more as well. And so the thing is that adding money is adding risk. Anytime you add risk, you add potential loss. Most people don't see it that way. I could have made more, but I could have also lost more too. And that's the completing of that sentence, right? So what people say is I could have made more. It's really, you're missing the other half of the sentence. You could have made more, you could have lost more. It's the unknown, you'll never know the difference to, but you shouldn't be biased to one side. Like I could have made more, shit, I need to get in on this. You say, I could have made more, so let me get in on this. And you have a tendency to want to get in. But then you say, but I could lose more, so let me not get in on this. And then you tip the seesaw the other way, and then you balance it out and neutralize the thought, and don't do anything at all. So that's the way you think about it. And so if you complete the sentence and say, well, I could have lost more either, then the fact that it was an unknown variable, then you're cool with not making more, because you're also very cool with not losing more. It feels better to not lose more. And you train yourself to say, hey, I made something. A win is a win. That's good. And that's how you quit. If you're smoking, you want to quit smoking, you need something to focus on. I teach people, like, if they want to smoke and get rid of smoking, you can't get rid of the addictive personality you have. If you're smoking, you're always going to smoke. You're going to be fighting all day to get rid of smoking, but in reality, the problem isn't that you smoke. The problem is that you're addicted to something. You're never going to get rid of an addictive personality. Most people try to battle the thing that their vice is instead of battling the addictive part of their personality. So how you get rid of smoking? You may teach you guys, if you ever have a smoker in your life and they want to quit, this is what you do. You start taking them to the gym. Get them addicted to something different. They're going to be addicted to something. Get them addicted to something healthy, especially going to the gym. Because when they start throwing up in their own expensive shoes, the minute they walk out of the fucking gym, they'll stop smoking because they don't like throwing up. And this has helped with so many people I know and friends I know, is that you need to train your brain to be addicted to something else, and just assume that you're always going to be addicted to something. Be addicted to something that, by definition, you're more addicted to that than the other thing, and then that thing helps you. You're more addicted to working out, you'll probably start smoking because you like working out more. And then all of a sudden, smoking doesn't feel the vice that the workout does. The fact that it actually hurts you when you work out, it actually makes you start to be like, I'm tired of throwing up. It actually hurts me more than it likes me, so let me not do it. Just like adding to a winning position. It hurts you more than it likes you, then probably won't do it. And I've learned over time, not chasing winning trades by adding to my risk has been the best thing for my trading win rate and my trading profits. So whenever you're thinking about how you're trying to analyze the thought is basically, if you put in small and win small, you tell yourself, hey, that's money I didn't have. A win is a win. All right. A small win is a small win, because it's also a small loss if you were wrong. And that doesn't feel so bad. It doesn't feel like you're missing out. It doesn't feel like you need to go get your next cigarette. It just feels like, hey, I know they brought me out a really small bite of some good food. And man, that's some good food I didn't get to taste. It's not, I wish I had 10 times of that, even though you want 10 times of that. Be happy you got to taste something good and just stay consistent with that. That's why the rule is when the trade is green and it's taken off, I'm trying to get out first while other suckers are trying to get in. I'm usually in when people think it's losing, and then I get in, and then I usually get out when people are trying to get in. And that quick in and out has been kind of my style of trading. But like I say, the high win rate that I have is reflective of the high probability setups. I long in liquidity pockets when markets are liquid. Liquid markets tend to not crash, and they tend to try to find stabilization. And I play these all day long. Bull zone bottoms, you guys know. Bear zone tops, you guys know. Monthly hedge pressure, you guys know. This DD bands. These are 4 entries I take that all have greater than 80 or 90% setups under the most ideal conditions. This little list right here will give you a box shooter. So I basically just aim for base hits all day long. You guys come to the stream, you'll watch me do that. I mean, it's very important that you learn that, especially in the trader funding world, you want to stay out of the market as much as possible. Punished on big wins, punished on volatility, you're punished on consistency, you're punished on trailing drawdown. You even lose when you're winning. You lose if you win the wrong way. You lose if you hold on for a winner for too long. You lose if the market gives you a home run on a winner. There's no real way to win the trader funding program other than to sneak along inconspicuously, nice and steady, and actually be consistent with base hits. The only way you're going to win. It's how I won. It's how I keep winning. And I'm completely profiting from Tradeify to the base hit method. A couple questions you guys have heading to lunch. Hey, Patty, it's good chatting with you. We'll see you. Have a great rest of your day, and have a great holiday weekend, you guys. Volatility's been extreme over the tariff talk. Check out, volatility's been crazy. So I've been doing a lot of like small, spread my risk out. You guys have never seen me been taking like 5 or 6 contract trades. You've seen me throwing 1, maybe 2 max, right? Like rarest case 3 in this environment, like nothing big. How do I feel about a chain smoker here? It feels like just a distraction, be it a good day or bad day, will become a need. Same as in trading, people feel they need to push trades. Right, there's like a need that you have to fill. And if you fill your need with something better, and it's like, I could have made more, instead of that, say, hey, I made something. That's cool. Glad I didn't lose. And that's like That's like going to the gym. It's a different mentality for the same thing. And you're addicted to winning each day. Be addicted to a high win rate instead of be addicted to making money. And it does one of the last things that it becomes easier to have that mentality the more money you have. And this is one of the unfortunate things with trading is you are rewarded with a better psychological framework the more money you do have. It might be different between you and me. So I'm 15 years into the game. I have a ton of money set aside for trading that I don't even spend on anything. I've got a ton of money in other accounts that I use for spending. The trading money and the spending money very rarely, if ever, overlap. The trading money, I take the millions of dollars I made and I built Rocket Scooter with it. I mean, the millions of dollars I made, I built a marketplace with it. I take that money and do other things with it. It's a play money. I never feel the need to get the money. And there's a hurdle you get over at some point in life. If you need money to make money with trading and you're just starting out, there's a whole different tie you have to that money because it's needed for something. You're gonna be a little more attached to it, like a relationship. You have a harder time letting go. You're gonna have a harder time losing. It's gonna mean a lot more to you to not win big or to not. To me, I don't care if I win big or lose because I'm not gonna spend that money on anything. That money's just gonna keep trading. My goal is to keep trading. And so if I make a little bit, I'm never like I could have made more because I don't care how much I make. And that's a whole hurdle that if you get over, you'll realize trading becomes easier. It's unfortunate that you can't just immediately come out the door at that. But if you do come out the door at that with a good sensibility about not needing the money you're trading with, trading becomes a whole hell of a lot easier, like infinitely easier. Trader funding programs allow you to have that mentality because you're not really spending a lot of money. Relative to you might be a lot of money, but in the long haul of things, it's not a lot of money. You're not blowing up 20 or 50K a month in real trading accounts. You might be spending like a couple grand a month. And that's a normal entertainment budget for an average person working that makes a, high fives or low six-figure salary, easily can afford $1,000 a month of entertainment money to trade with. You're not busting. Your family's not going to be poor. Be blowing up your accounts, so it's tolerable. And it helps you have that mentality, even if you don't have the big bankroll sitting on the side to keep you from overtrading. I don't overtrade because I don't need the money. I care about looking good and winning and kicking ass on stream, making trades win rather than winning a whole lot. I like to show green, even if it's $100 a day. Then I do like to show 50,000 one day and down 30 the next and up 80 the next. I like to beat the game because it's fun to win. Doesn't matter how much I win. If I walk away with a blue ribbon or a 10-foot fucking tall trophy, they're both victories to me and they both go on my trophy case. Get it? A win is the win, not the amount of the win. It's not a lesser win and a greater win. A win is a win. And that's the basic mentality. It doesn't matter if I hit a home run, if I get on base, I'm looking for base hits. And both of them got me on base. So they're both valuable to me. And so the longer you stay in the game, the more you realize it's not I could have made more. It's if I jump into that trade, the possibility of loss goes up. And then that's where I avoid it. I don't need to make more money. I don't need more money. Trust me, I'm very well off. So I don't need to make, and have that, even if you're not well off, have that mentality the same way. I'm very well off. I don't need this money. Trade with money that's not your bills. And you're going to realize you will do a whole lot better mentally if the money is not needed for anything, because you don't throw extra variables to your trade. Like, oh crap, rent is due. I need to make $2,000 by the end of this week. Shit. Well, you're going to be making more trades than you need to because you need to. I don't need to do anything. I can sit out 5 days in a row and I'm cool because I don't need it. I'm treating every trade like a business decision. Like I have a restaurant and I'm trying to add a new thing to the menu. I'm going to put some thought into it. I'm in no hurry. I need to make a wise decision every time. And so that is one of the unfortunate advantages you may not have at this point in your game. But trust me, when you have that mentality, it is an advantage. The more money you have, the less you need it. You just naturally get an advantage mentally, right? And it's a hard thing to teach somebody because it's more just like you have an advantage naturally. So the better you do, not only are you getting better from experience, but you're also getting better financially, whether you're in no rush to make trades. And if you don't have the money now to be in a rush to make trades, have that mentality now. Just don't be in a rush to make trades because it's the proper mentality to have. So Kim, if you can't make it to the live classes that I do, the videos are recorded and just being part of the community, even worth it. Maybe next time around I can do the boot camp at a different time. But the live is just my commentary to go with it. The classes themselves are pre-recorded. You can watch them anyways. And that's part of it. What would I say a break even? What would you say to a break even trader? That you are one step away from victory. If you are breaking even, you are so close to getting there. The hardest part in trading is to break even. That's the hardest hurdle. If you are breaking even, you are moments away from your goal, whether that's tomorrow or next week or 10 years from now. You are right near the edge. You've got one more hurdle to get over. That's it. Breaking even and not losing the money you have is the hardest hurdle in trading. So those of you that are break even, you are one step away. Now, how long it takes you to achieve the next step is up to you, and it takes a variable amount of time. You could be right there. You could be missing one little piece. Breaking even is your first goal as a trader. And then from there, it's easy. Now you need to figure out how to make money. Now you can fine tune your approach. If you're breaking even, you've got risk management on point. You got it? So if you're breaking even, you're not losing. And I forgot who said this. There's a famous trader that said this, but they said, as long as you don't, the only way to make money in trading is to not lose money in trading. That's it. That's the paraphrase. The only way you make money is by not losing money. And if you don't lose money in trading, the profits will come. Now, what that means is that it's a kind of like an analogy or metaphor or whatever that's stating that losing money is a loss, but not making money is not a loss. The only way you lose is physically by losing money. If you're not making money, it's actually a win. So the win is not losing in trading. So if you're walking away flat and not losing, you are winning as a trader. You're winning zero, but you're winning. Because trading statistically makes everyone lose. So as long as you're not losing, you're beating the system. I want you guys to all see that. Best case, you break even on your first month after taxes on trader funding programs. Oh, I'm not reading you guys the commentary, sorry. Dakota at Top Step has a very low win rate and is consistently the top trader list. The thoughts? I think Dakota just went on a very big winning streak. I don't think he's consistently the top trader. I think he made a whole lot of money and then he just is there on the list. I don't think he's continuing to grow his profits. And again, this is part of what trading, not like he's a bad trader. He's not a high win rate trader. He's not terrible either, but Dakota's a very average trader. I've watched him trade. And this isn't throwing shade. I like Dakota. He's a cool kid. He's not an expert by any means. He's not even that great. He's above average. And he got a very lucky streak. Those are good recipes to make money. But I don't think Dakota could pull that trick out of his hat again multiple times. Not yet. He's very new to the game. He's a young guy. But he's a good candidate for becoming a great trader one day. Any trader is going to go through lucky streaks. Any trader is going to get big windfalls every once in a while. It happens. But it's very rare for somebody to be consistent with the low win rate. It just is. You get lucky on a big streak, and streaks happen. I mean, Pat Whelan went on a streak and made, what was it, like $600,000 in Apex. But he also, for the previous couple of years, as he revealed, didn't do so hot. And it's a part of trading is that you will sometimes go on a big old hot streak. Jade Cap about to get his $3 million payout. Crazy, right? What if that's just a hot streak? And it's part of trading. You will go on hot streaks. You might have a 2 or 3 banging month setup. But the only way to promise or to consistently make money is to kind of have a higher win rate or a statistical edge, one of the two. And so like in Dakota's example, he's a better than average trader, not great or the best trader by any means. But that's because he's new, and we were all there at some point, and that's not throwing shade. I think he's going to be very good one day. Probably, 10, 15 years of experience under his belt, probably be crushing it. Yeah. Nihal says, how would he talk somebody into going down which route? Yeah, and the law of large numbers is exactly what happens to traders like Dakota. If you have a low win rate, ultimately it's going to catch up with you. And that's just what happens. Again, a low win rate, even if you only win 30% of your trades, all 3 of those trades come 3 months in a row, and then you made millions of bucks. And then over the course of time, you're going to whittle it away. You know, I mean, your win rate will ultimately catch up to you the longer you're in the market. It's just math. The trading rate, because a lot of it's quite scary. It's not scary because you can control. This is what's hard. What's scary is what's possible. But in trading, there is one thing that you can fully control. It seems unpredictable and random, and it is. The stock market's pretty random. But if you were to say one thing out there that isn't random, that you have full control over, is you have full control over how much you're willing to lose. You walk into a casino, it might be scary, but if you only walk in there with $5 in your pocket, what do you have to be scared of? If you know exactly how much you're going to lose, then you're in control of that. Right? Everything is working against you, right? But you also know that there are some things that can work in your favor, and you limit your risk, and that's where you have control. Always think like that. You can limit how much you're going to lose. You're in full control of that. No matter how random or how big the system is or how bad it works against you, no one can make you lose more than you're willing to lose. And that part you win. They can't take more money than you put in. Well, unless you're in a leveraged account, I guess. But Dakota does well in close your eyes and press bid markets, break even other structures. Yeah, and again, when you watch somebody trade over long periods of time, it's going to be very rare that you see somebody consistently put up numbers unless they have a high win rate. There's just no way around it. That's why I consistently put up good numbers. But like I said, you don't see me also saying, guys, I made 100K today, right? My normal trading day with these Tradeifys has been, 5 to 10K consistent though. And 9 out of 10 days is a winning day. And so I've been lucky. Luck has also gone in my favor, but the statistics help me carry that. Even if the luck doesn't go in my favor. The position sizing with the statistics is what helps keep me alive. And the only reason I do as well as I do is because I don't die in the markets. I don't die on a hill believing in a position. I cut my losses quick and get my risk managed very well. And that's really what keeps you going. I may not be, you may not wake up tomorrow and see me climb from place 0 to place 1 on the leaderboard, but I'll consistently be at the top, near the top. If I was doing a leaderboard. Is trading, and again, win rate and controlling your position is the key to surviving long term as a trader. Because is trading micros or minis, which are the best 50K funded account? So you shouldn't look at the funded account. You should look about the drawdown. We already know if you if you go back in the video, I talked about how I calculate the position size based on the amount of drawdown they give you. You have to look at your consistency role and your time and market roles. There's a whole thing goes with it. What I recommend to say if someone has a 6-figure federal job but hasn't been paid for 1.5 years, pay issues, Google, interested has to use props for his family. Okay. Wait, you haven't been paid by the government in 1.5 years? I'll Google if interested. Yeah, I want to check that out. Has to use prop to support their family? Oh, man. Well, I'm very sorry to hear that. If you have to use prop to support your family, it kind of comes down to, it's kind of hard, right? You have to try to be consistent. The best bet you have is to be consistent and not try to swing for fences. Don't be like, if I only make 50K this month, I'm set for the rest of the year. You know what I mean? The mentality is very toxic because you'll lose everything so quick. You have to slug it out. You have to do kind of like I said, my only recommendation to succeed in prop world is slow and steady base hits. Support a family. I don't know what your bills are. For most people, your bills are $5,000 to $10,000 a month on average. If you have a family and kids and house and car and stuff, that's about right. And it's not hard to pull $5,000 out of a Tradeify if you're good and consistent. I've got 6 payouts with them in the 2 months I've been with them, which is what? $24,000. I could have supported my family on that. Well, I guess that's before taxes, but it's hard. It is really hard to support your family on prop firms unless you're consistent. It's not easy. I live in Vancouver. It's expensive as fuck. Yeah, it is. It is. Everyone's a genius in a bull market. O said, yeah, exactly. When market goes up only doesn't make you a good trader. At times like this, will make you a good trader. Yeah, if you can survive and you're breaking even, especially, or you're surviving in this bear market, that you'll be good for the good times. The goal in trading, I always tell people, over a long period of time is just to survive. You don't want to lose money. You need to survive, because when the bull market comes back and it's nice and easy for everyone, money will just be falling in your lap. You don't want to be the one that busts your account and lost all your money. Markets are like this. Yep. So it's hard for me to recommend prop trading to support family, because I don't know your stats or how well you do. It's hard to make any money as a prop trader, much less consistent money to support a family. Prop trading is penalized very heavily by taxes and fees and all that stuff. It's like getting a paycheck and losing 60% of what you made to all the fees and taxes, you know. So you have to be really good and really consistent. You can't have good month, bad month, good month, bad month. You have to be like Matt, like me, have good month every month. And it comes from just patience, slowness, you know, finding something that you have that's a general edge, and then just milking it small and just slowly growing. What's the best to trade in prop firm? NAS or ES? ES, always. And there again, you can scale them where they're the same, but the reason that they're the best is that NASDAQ always has like a 4 to 8 tick spread, while ES only has a 1 tick spread. NASDAQ penalizes you on market orders because the ask and bid are so spread apart from each other. NASDAQ will move faster per contract, but that's because the contract has more margin. By technically speaking, NASDAQ moves up 8 for every 5 the S&P moves. So one contract on S&P that makes $50, the same contract on NASDAQ would make $80. But it's just because it's leveraged differently. So you should adjust your position size when you're trading NASDAQ as a rule of thumb. For every 2 ES you trade, roughly you'll trade like 1 NASDAQ in that same ratio. Or basically every 8 ES, you'll trade 5 NASDAQ. That's really the ratio, but almost 2 to 1, give or take. And then you'll keep the risk the same, but even though you can scale the positions differently to make the same amount of money for the margin that's spent, NASDAQ always has a spread. So if I were to buy into the ask, I'm already down $100 in my trade because the spread is so big. If I were to sell immediately to the bid, I'm down 100. If I were to immediately buy in the S&P, I'm only down 1250, usually just 1 tick. So if you throw a market order at NASDAQ, you have a bigger hurdle to get over because of the spread between the two. So by nature, every contract you add amplifies that position. If I were to buy 5 NASDAQ contracts with a spread of 2 points, I'm already down, $500 or whatever it is. $20 a point, actually. But you get the illusion. I'm saying $20 a point. So $100 for every 5 points, which would be equivalent to $65 in ES. The spread for number of points, whatever. You know what I'm saying? NASDAQ has a higher bid-ask spread, so therefore you have a bigger hurdle to get over. Using limit orders gets rid of that, but no day trader I know uses limit orders, really. Speed is usually what people do. If you use limit order, any more questions for me, guys? Oh, somebody said, how does Dakota stay on the leaderboard consistently with the low win rate? And my answer was he doesn't. Anybody can get on a leaderboard, want a really good hot streak, but over time, a low win rate catches up to everybody. 3 or 4 years is going to make the law of large numbers will make your win rate realized. You can get lucky with low win rate by having high reward to risk ratios. to have lucky streaks carry you forever is not statistically normal or possible. So people are asking, like, because I was saying high win rate is the only way to stay consistent and to be. There's a difference between like getting, you know, like he's a decent trader. Like, clearly not like the best strategy or the best trader, but decent enough to get on a leaderboard. But I argue that over time, you know, people will pass him up or he'll fall off with a low win rate because it requires a high win rate in the prop world to consistently be there. In 5 to 10 years, his name won't be on the board with a low win rate. Do the pivot points reset at NY Open and Market Open? Ours do, yeah. They do. I'm live every morning at 8:30 Eastern, so an hour for market opens. We should have a big turnout every single morning for the trading sessions. We've been growing pretty quick. And you guys come every single morning. We'll be here. I do prop trading. I'm trading with Tradeify. You know, we have Rocket Scooter as the name of our company. We made this trading platform that you see. It deals in high volume pivots based on different exploits. A lot of our setups have 80-90% setups. We teach all this position sizing rules, all this thing that you saw in this YouTube session. We teach all this in our boot camp, which is like one of the best things we do. It's only $20 for 20 days if you guys ever want to check it out. We start this boot camp over in another week, which should be fun. On holidays, I like to stream because, you know, you guys are still going about your day. And sometimes it's very rare that we actually can sit back and just chit chat about whatever. A quick summary about my trading. What would you like to know? My style is I utilize the strongest bull bear setups at Rocket Scooter under ideal conditions, and I account for volatility, and I spread my risk around my pivots, and I'm trading pivot to pivot. I find liquidity and I long it. I use this guide exclusively. Some of these setups are 80 and 90% when all these lights are green, statistically giving me an edge. How's it going with my Windows installation issue? So Windows didn't install. I found out that my CPU was corrupt. That ended up being the case. My CPU had failed or was failing, and that's what was happening. It could have been that it was getting improper heat dissipation from a bad. When I took it apart, the thermal paste was kind of like chipped and cracked and not evenly coating in certain areas. So it could develop hot spots on the processor, which ultimately, after 4 years, caused the processor just to cook itself and die. And I knew that because I went and bought a new CPU mother. The first thing I did was I swapped out my hard drive, thinking the hard drive was failing. The PSU diagnostics all looked good. Everything was good. Nothing looked like PSU was like failing or cycling weird or higher voltages than normal or higher temperatures than normal. Everything looked good there. So my PSU was good. I switched out the hard drive to think that was the problem. And I tried to install Windows, and the processor just was like not getting over the Windows installation. I spent a whole day trying to install Windows. It wouldn't work. Then finally, when it finally worked, tried to install programs. They didn't work. Something was going on. So now I was like, okay, let me just replace the motherboard and the chip. And I finally went and got an AMD processor. It's the first time since college I've been AMD. So now I got AMD running. Everything's good. I got a 9950 chip. And then I turned everything on, got everything going. And then the motherboard only recognized one of my graphics cards. It didn't recognize the second graphics card. So I was trying to fiddle around with like reinstalling the drivers for the motherboard and trying to see if that worked. Nothing I can do could get the motherboard to recognize my second graphics card. So I have a whole new problem. I swapped the graphics cards in the sockets. So I know it's not the cards. The cards work fine. It's the second socket. It's not picking up the new card. And I have a 1200 watt power supply. It's getting enough power to the board. All the connectors are there. So I don't know what the problem is. For the first time in I don't know how many fucking years, I can't figure out a computer problem. I got to take my shit to Micro Center. I'm about to go drop my computer off and tell them, hey, either A, the motherboard's got a faulty slot, something's wrong here, or I just can't figure out which driver I need to install. Can you guys do it for me? I ripped out all my water cooling. I was so angry in the middle of the night last night. I was actually just cutting the wiring. I was like, fuck this computer. And I started, that cool computer I have, I took scissors and I started cutting all the wires just to rip everything out. I was like, you know, I'm tired of having, because I took all my water cooling out and put it in and took it out and put it in, drained that thing like 6 times. I swear my fingers are raw from doing it. And I'm like, I'm just tired of fiddling with this. I'm going to have a loud air-cooled machine going forward. So I'm going to drop off at Micro Center. I can't use my 3080 Ti's anymore because I threw away the stock cooling. So I got to buy brand new graphics cards today. I'm probably going to get 5080s because it's not a gaming machine. I don't need like 3080 Ti's or anything. So I might just get like two 5080s to power the monitors and just have all air-cooled machine going forward. Yeah, I basically rage quit. I'm like, I am not taking this apart and putting it back together and taking it apart and back together. I was like, I'm going to take everything out of the box and just breadboard this machine and just play with it till I get something to work. And I was like, well, fuck it. I'm just going to take the Micro Center. Rage quit. Yeah, that's the boot camp link. So right now I've got a very good, everything's set up. My RAM wasn't a problem. It was probably the CPU. Now this time I can't get the motherboard to work, so I don't know. So, boo. But now I got all my water cooling is like ripped apart. So I had fun building that computer. It was really nice to look at. But going forward, I'm just, since it's the stream machine, it doesn't need to be like an elite gaming box with all this extra stuff in it anymore. It just needs to work. And I need to be able to swap out components quickly. So air cooling is just, it's simple to get in and get out. Am I hiring in Rockstar for any remote roles? You need a job that actually pays. If we had extra capital, I would be hiring. Right now, we've completely maxed out based on our budget. I hope we grow big enough to hire a whole lot more people, though, because my visions of this company are massive. You remember the days when you only bought AMD when we couldn't afford Intel? Oh, yeah, those were the days back in the day. Remember, this was like, I would say like 1999 and 2000 when like AMD was like running so crazy. And then Pentium 3 and 4 came out. And then there was a race to like everyone trying to get to the first 1 gigahertz processor. I remember like in the early 2000s, there was like, they were racing each other so quickly to get to 1 gigahertz first. Then Intel slowly took over quickly. They kind of won the gigahertz war. And then Intel was a fan favorite for a while. But then over the last like 5 years, I think AMD's just slaughtered them in every metric. I was just so used to using Intel chips that I never wanted to switch because I got so used to how they performed and how they worked. And then now I'm just like, if my processor melted and I'm like, that's what happened, then fuck Intel, I'm done. Rocket Scooter IPO win, that'd be kind of fun. Thanks for the talk today. Really helpful. Been loving the boot camp. Thanks, Patrick. Appreciate you. And you guys are having fun at the boot camp. We love it. Ryzen's been crushing it. Yeah. I got a 9950X. I didn't get the X3D because I'm now segregating since I have a whole new computer for gaming, like 5090, fully set up. Dude, it's a fucking monster, this computer. The one I'm on now. I'm going to make the other computer just a work machine. I thought about getting a Threadripper, but it's not really needed. So I got the 9950X. Super cheap. It was like $400 maybe for like one of their highest end processors they have. So that is way overkill for anything I want to do. Yeah. And I don't need like my 3080 Ti's were good. Anything 4000, like a 40, even a 4070 is somewhat of an upgrade. Not that much, but 5080 would be probably like 25% faster, even though I'm not going to be gaming on it. And they're probably $500 a piece. So I'm going to go get 2 of them. I'm going to go to Micro Center. I'm going to buy those 2 graphics cards. I'm going to drop my box off and I say, you guys give me a computer fixed and ready to go. Here's the pieces of what's left that I didn't destroy. When you buy an eval and passive, when you reach funded stage, you think you become emotional and don't keep stop lossing how much you should risk for each trade. That's like a loaded question. There's a lot of work. I'd say, trying to get over emotions that you have, it's hard to say. You need to reduce your time in the market, I'd say. And I would say spend a little bit more money to not have to do evals. Try straight to funded or try something that has a quicker path to getting funded. You don't need to be like sitting there for longer. If emotions are your battle, you need to be kind of quicker to your goals. What's the best affordable laptop that you can stream live trading and run all your trading software? You don't need much to do that. You just basically need like a standard multi-core processor. Even now, You can spend $1,500 and get a decent processor, 8 core. The new Intels are like 24 core processors. I mean, you can get, 12th gen, 11th gen, you should be fine. Before I bought this laptop, I was streaming off of like a 10th gen Intel, and I'd live stream with it. It was totally fine. You bought the 5900X a few years ago and can do anything with 4K editing. Oh yeah. You don't realize how affordable Tradeify straight to fund it is when you do the math. This is what I'm trying to tell people. I might be the only person in Wall Street that sees it. Tradeify straight to fund it is a gold mine for the price. For $500 per account, you get rid of all the major rules. No trailing drawdown, straight to funded, no eval, time and market. The limit there, how they mitigate their risk, is it's 10 days to pay out. And the payouts are capped. But still, the payouts are almost guaranteed for me. Like, I've been getting payouts every 10 days for the most part, every other. There's only one period I didn't get a payout. I've got 6 payouts. I've been with them for 2 months. So once you go hit your caps, and they move you to live. But yeah, no, it's crazy how affordable it is. No trailing drawdown. I would pay 10 times the price for no trailing drawdown over Apex any day. Is it best to buy lifetime or pay monthly after you pass an eval? If you're talking about with us, lifetime is the thing that everyone ultimately goes to because it saves you money for our community. Like 75% of our members are lifetime, maybe more. But thoughts on ETF? I had a friend get denied payout a while ago. Was made trade from our days. I haven't touched them since that. My thoughts of ETF have been changed as of lately. I have a lot of personal stories from people I trust, telling me stories about people they trust, etc. Word is kind of going around that their rules are just too hard and their payout denials are too obscure to be like my chosen firm to use compared to the other firms that are out there. Your job as a trader is to find the firm that matches the best. They're not a bad firm. They haven't been bad to me personally. They've been good to me. My payouts have all come and whatever. I don't know if the person that got denied for a weird rule, but ETF is known for having some of the hardest rules in the game. So on the merits of everything not being, they're not saying they're shady or bad. On the merits of tit for tat, there's really no benefit that they have over any of the other trading firms. And we even analyzed their direct to funded program live on stream, and their direct to funded program category to category was Tradeify beaten almost every category for the most part for value. So I don't really know. I can't really. I recommend them personally because they're nice people and they haven't denied me, but I can't speak for anyone else. I can't recommend them on being good value. I think they're one of the worst valued firms out there as far as what you pay for what you get. I don't know why they don't see that, but that's just their model. And for you as a trader, their model may be to protect their risk more, which is why it's harder to win. From you as a trader, take profit in Tradeify and Top Step. This is where you want to be for your better chance of winning. Yeah, those are the ones that give you the best rule, and maybe they're taking more risk for that. But it doesn't matter for you. You need to get in and get your payouts quick before companies go belly up. That's kind of the goal of this. So yeah, Tradeify is good. You can easily charge for this advice if you're really listening. You've given everyone the sauce. I appreciate it, man. Well, I mean, I like streaming and I like teaching and I like doing this stuff. That's why I teach just really drawn out trading boot camp. It's 20 days of sessions like this. And I only charge $20. I make it $1 a session because I don't make money selling courses. For me, I do love doing this and I love bringing awareness to traders and helping them out. And my boot camp is $1 a day. So you come and put $1 in the tip jar and then that money goes to pay the 2 employees that make these cool handouts you see on stream. And I pay them monthly salaries. One of them lives in Nigeria. One of them is college age, just got out of college, starting her life out. So both of these people are supporting them with your $20 boot camp, giving them their salary, which is kind of nice. For last 11 hours, Tradeify discount is 40% now. Yeah, if you have your first account with them, it's 40% off. Does CPT still have live trailing drawdown once you get funded? I think there's a buffer. I haven't used them yet because I'm still stuck to Tradeify, but I'm going to use TBT next. Live trailing drawdown to a buffer, and then I think it stops. Okay, guys. All right, so we'll see y'all later. I'm going to take off. Enjoy your Easter weekend or whatever 3-day weekend you got with your friends, family. Have some fun. It's Good Friday, so markets are closed. American markets are closed. And if you're Christian or whatever religions out there, if y'all celebrate anything related to Easter this time, happy Easter to you and your families. I'm gonna probably go pick up a little man and take him to Dave and Buster's or something. Have just a fun day. It's better to trade in a real personal account rather than a trader funding program. 100%, David. 100%. You're taxed better. 60-40 rule is better for you. You're taxed better. It's your money. You should. Your real goal is to make as much money you can in the prop firms and then use it to fund your own self as a trader. Yes. Absolutely. 100% is your goal. You can't sustain longevity in prop firms. Each one of them will cap you out and move you to live. So prop firm is like a limited sponge at which you can take money from. You can't indefinitely make money on prop firms either. And that's the advice of the other guy that said, support your family with prop firms. At some point, each prop firm will cut you off and you can't trade with them anymore. They'll move you to live, and if you blow up, then you can't use them. You're stuck. So a lot of times when you move to live, a prop firm will forbid you from trading evals for X amount of time. When I went live with ETF, they will not allow me to trade their evals for 3 years. I'm on a 3-year ban from their eval program. So that means if I blow up the live account, I can't trade with ETF ever again for 3 years. So there is peaks to how much you can make from the prop firms for most average people. Influencers, they might bend the rules for a little bit, let them stay in it for longer, but usually they'll move you to live. And at that point, you get one chance. And if you blow it up, you're done. They usually ban you. So keep that in mind. So take as much as you can and start your own trading journey with it. All right. We'll see you on Monday. Have a good one.